Friday already, the Trading Titan. Hey, George T. Ron, I think I just look forward to nicknames every morning. It's going to be sad when you run out of them. Good morning, Derek. Good morning, George. Great to see you guys. Got some new names in here, too. I like that. We got some Urban Survival, some Nexus Master, some 24-hour something market. Heck yeah, welcome to the room, guys. Good to have you. Hope everybody's doing great. Hope you're excited to be here. I am. I'm always excited to be here. How charmed is my life to get to do this for a living. We're going to get going with news, guys, the way we do each and every morning. You Bandmaster. Guys, this is how we start our day. Every day we go to forexfactory.com/calendar and we talk about and look for high impact news. We look for news that could disrupt patterns. And that's exactly what day trading is, guys. It's a pattern. And a lot of you guys remember video games from the 80s. And in the 80s, you could drop a quarter into Pac-Man, and if you followed the pattern, you could piss off every kid behind you for hours because that pattern allowed you to stay in the game. Good morning, Miss Adriana. It's nice to see your smiling face in here today. So, patterns, guys, you've been there, right? You've done that. You guys know what I'm talking about. As long as you followed the pattern, you knew that you were going to do all right. As long as you stuck to the plan, you knew that the potential was there for things to work out. And when you deviated from the plan, when you sidetracked from the pattern, guys, you got eaten by those silly little ghosts. So I want you to keep that in mind as we talk today. We're going to talk about patterns. We're going to talk about things that do the same thing every day. Good morning, Paul. Good morning, Steve. Excuse me. The market has a memory. Nexgen has spent 28 years teaching people how to recognize that memory, how to write it down in a set of rules, and how to give you a checklist so that you can focus on patterns instead of money, guys, because money in trading is a byproduct. It's a result of the process that yields the money. So let's focus on process today. And one of the things that happens, all that to say, guys, when there is news in the market, when there is high impact news, like there was at 8:30, it has the potential, and this is one of the things, it is the potential to disrupt. It is the potential to create spikes. Good morning, John. It is the potential for the people that control the market to make irrational or even rational decisions that could make your patterns no longer viable. So anytime you see high impact news, it's okay to sit on your hands and do nothing. Anytime you see medium impact news, it's okay to protect your position. So we've already made it through the first round of news, guys. That red box is what I'm looking for each and every morning. At 10 a.m., we've got the preliminary University of Michigan consumer sentiment. I have no idea what that means. It's like trading places, right? It's an orange juice report. But somebody might get upset about it. Somebody might flood the market with orders. Somebody might pull their whole positions because of it. So at about 9:55, I'm probably going to pump the brakes on my trading and say, what a great time to take a break. What a great time to go pet the dog, walk the dog, play a video game, anything other than throw myself in front of that emotional bus. So that's my first stop every morning, guys. And then we are going to, throughout the course of the next 3 hours, we're gonna focus on chart reading. We're going to focus on being able to look at our indicators and recognize a couple of advantages, whether you are on NinjaTrader or whether you are on TradingView. I will cover both. Good morning, Chariot. Good to see you. I'm going to talk about both platforms, and the similarities are uncanny, guys. But there are subtle differences that will need you to read each chart differently. So if you're on NinjaTrader, you're going to have a set of rules designed specifically for NinjaTrader. If you are on TradingView, you're going to have a set of rules and given a plan that is TradingView specific. So we're going to talk about Momentum. We're going to talk about having a market that's pushing in the direction of the trend, having the strength behind the move to make us feel good about being a part of the move. We're going to talk about clear path. We're going to be able to, you're going to be able to, I can already do it, look at your charts and recognize trouble, recognize things that could stop the market, recognize things that could kill the trend, and then you may even make the choice not to trade directly into them. And then finally, entry area, guys. We talk about entry area because when you have momentum, when there's nothing in the way, and you can define an entry area from a pattern that repeats itself over and over, you have what's called a high probability trend trade, guys. This is my focus for each and every one in the room. And I'm going to hand you plans that optimize your chances of success as a brand new user. And I'm going to give you study tools as well. So let's do that right now. I'm going to drop spreadsheets and plans in the room. I would encourage you, download these. The Ninja Trader is a KISS plan, and the Nexgen tracking sheet. Your Trading View plan says TV plan, and then there's a TV trade journal. We're going to talk about the best of the best, giving you the ability to find a way to have the potential to be profitable as you learn to read your indicators. And my goal for everyone in this room, each and every one of you, is that you look at your charts and out loud you say, I have momentum. There is nothing in my way. Let me go find an entry, guys. Your pets should get excited about momentum. Your pets should do circles and dance on their hind legs when the path is clear, because you're talking out loud and you're speaking in terms. Because when you know what's good and it's high probability, you're excited to take that entry. That's when you hold for those bigger moves. When you recognize that one advantage is no longer present, you put yourself in a medium probability scenario. And guys, these have to be managed a little more assertively. And then when you look at your charts and you say, dag nabbit, I don't have momentum or path, it's okay to say, I choose not to trade. There's billions of dollars of movement in the markets every day. I only have to capture 400 of it to become a six-figure trader. Let me sit on my hands and do nothing. And I'm going to remind you that you are in control of the entry. Nobody can make you take a trade. Nobody can force you into a position, guys. Trading is a solo sport, so it's just you and that nagging voice in the back of your head. When you know what's working for you, momentum path entry, or you know what's working against you, the absence of any, guys, you can make decisions on whether or not you're willing to enter that trade. You can make decisions on how aggressively that trade may need to be managed. So as we get into this first hour, it is a little lecture-y, I'm not going to lie. We're going to talk about rules, and you guys are going to be able to learn the trigger line and the Fibonacci rules for when it's okay to trade. I like to just say it's okay to trade when my rules are met, when I have momentum path and entry. And it's okay to not trade if they're not there, because guys, the next trade is coming. Everybody in the room has the ability to simulate. You should have the ability to take a picture and drop it in the room and tell me what you saw. For example, 8tick says, terrible trade. All I can say is fear of missing out kicked in hard today. Why? Because you tried to trade the potential of the breakout and it didn't work, right? And you let it ride. And that's probably the challenge, is that you didn't recognize when your trade was no longer working and hope kicked in, right? And guys, every time you post in the room, and we're going to talk about this, oh, you did win. It's hard to read. We'll come back to it. Every time you guys post in my room, what you get is a private session with me. We're going to talk about the good. We're going to talk about the bad. We're going to talk about the positives. We're going to talk about the negatives. We're going to focus on your chart read to see what you saw. So my feedback to you, 8ticks, describe your momentum, describe your path, right? Describe your entry and why. And you may have, it was a quick glance, but there was a lot going on. I'm going to have to look at it closer. And what you're going to do, guys, when you post in my room, you're going to discuss that momentum. That's one of the advantages. You're going to talk about the termination conditions that are one of the advantages. You're going to be able to show me where you entered. You're going to be able to show me where you exited. And guys, what your annotations are going to do, every time you write on a chart, you're writing a recipe. You're creating this solid thought process that goes with your advantages, that goes with the pattern that's been proven to win more than it loses. And they're also going to identify any challenges that you have. Maybe you trade directly into a blue line that could stop the market. You take that loss, but you didn't recognize that you traded into a termination condition. My job is to help you read your indicators more effectively. The second thing, posting in the room is going to get you where you want to be the fastest. Keep it simple in the beginning, guys. I give 2 plans each and every morning in the room. I give for my NinjaTrader users what's called the KISS plan. This is a way to optimize your chances of success, to keep you focused on reading your indicators. It gives you a very if-then pragmatic approach to entry, and it does the same for management, guys. And it gives you one trade that you can prove wins more than it loses. And then it sets you up for the second trade, the trade that you will use the chart reading from the first trade to be able to capture more opportunities in the market. If you are a trading plan user, a trading view user, guys, same thing. I'm giving you a plan. The plan talks about where you find your advantages, how you define your entries, everything that you need to enter the market on TradingView to have an edge. So both of those were already dropped in the room. And guys, repetition creates recognition. So one of the things we're going to do is we're going to talk about 3 rules, and then you'll be able to start taking pictures of what it looks like to have those 3 rules met. So I dropped the NinjaTrader. It's called the Nexgen tracking sheet. Your first tab is strong triggers, clear path, and entries, guys. The 3 rules, the 3 advantages, highlighted in green, as well as what it means to not have them met, the time where it's okay to sit on your hands and do nothing. The second tab is over 500 pictures of Nexgen users who've been presenting in my room, using these advantages, finding a way to profit, trading these patterns, and I just steal them and turn them into a study guide for you. Ideas on the NASDAQ on those Renko charts, management, the top 4 directly from the KISS plan that I dropped in the room. You're going to start to see patterns that repeat themselves. This is going to take you outside of the basics. You're going to begin to see more. And then finally, a trade tracking sheet, guys. And the trade tracking sheet is just your trade journal. Every time you take a picture of your trade, drop it in here. Talk about what you saw, but most importantly, talk about the feedback that you got, because very often, any mistakes that you guys made are fixable. I've made every mistake that you made. On the TradingView journal, same thing. 3 different trades on the plan, pictures of each trade, ideas on management, termination conditions, and then again a trade tracking sheet, guys. A place for you to put your trades to get the feedback. So when we get moving here, we're going to talk about rules. We're going to talk about 3 rules. And both checklists for both platforms are 3 things deep. That's it. 3 rules creating 3 advantages. So we're going to go Renko first, guys. This is the recipe for the high probability trend trade, where each indicator on every chart agrees with the rules for the trade. Momentum, clear path, and entry. These 3 rules happen on only 2 charts. You have a big chart. It's a slow chart. It's a very broad stroke of a brush, and it's difficult to see change. But what you can see is the overall opinion of the market. You can see what the people in charge want to have happen. So you'll use the first bar on this big slow chart to define direction, momentum, and areas. Your first 2 rules, the advantage of momentum, the advantage of a clear path, they're going to be noticeable on the first bar. Inside of this bar, when you go to a smaller chart, a faster chart, a refinement chart, the smaller chart is going to be used to pinpoint entries, to take that final rule and recognize where the market is most likely to continue with the already established trend. By using this refinement chart, you are able to reduce risk dramatically. You are able to increase profit potential. So it's only 3 rules, and it's only 2 charts, and no matter which platform you're on, I want you to remember that you're not in control. The only thing you will ever be in control of is whether or not your rules are met. And your rules have been proven by you, or they will be proven by you, to win more than they lose. So your big chart, whether it's the 15-minute or the 13-2, whether it's Renko or minutes, guys, this is the big crowd. These are the men and women who create trends. These are the men and women who react at news. These are the men and women who get to those key areas on your charts and decide to exit, decide to enter, decide to fight one another. Going with the flow is the path of least resistance. Your small chart is the fighters. These are the people that when everything says up from the large crowd, they want it to go down. Or when the large crowd is really pushing things down, they want it to go up, guys. And we love the small crowd because the small crowd is going to get you to that bounce point where the market is most likely to continue. You will be able to call your shots. You will know exactly where your entry is before the market ever gets there, and you'll be able to wait for it with a limit order right at an area inside of triggers. So let's get going on Renko, and let's talk about the tools that we're using. So for my new users, for my demos, for my new guys, my new gals, you're going to see triggers on both charts. You're going to see small triggers, 2 solid lines. These are a fast-moving average. I don't want you to concern yourself with the math that creates them. I want you to know that 2 small lines is a small trigger. 2 larger dash lines is a large trigger. Now, when we get moving and start talking about rules, these trigger lines are going to define the momentum in the market. They're going to let you know that rule number 1 is met. These trigger lines are going to define the termination conditions, the areas that could stop the market for rule number 2. And these trigger lines, specifically the large, are going to help you pinpoint with uncanny accuracy where the market is most likely to bounce and continue with the trend for your entry rules. So trigger lines will be on both charts, and they will come into everything that you do. You're also going to see on the large chart areas. You'll see them on the small chart as well, guys. Areas, I want you to think of them as horizontal lines on the big chart. That's it. And they do have names. There's divergence highs. This is a magenta line. It's going to print from a pivot, and a pivot means that the market went up and then down. And if there is a loss of momentum, if momentum is not following price, your software runs a calculation, and it prints this pink line about 2 bars down in the pivot. There is a negative number that lets you know that divergence is true. That negative number has nothing to do with anything. It is a byproduct of the calculation. If there is a loss of momentum at a low pivot, you will see a cyan line. And for those of you that aren't art savvy, it's hot pink and baby blue. And it lets you know that there's a loss of momentum. So every time you see divergence on a chart, I want you to say, there's a loss of momentum. Renko users will see these fibs, Fibonacci resistance. On your large chart, it comes from 3 separate time frames to increase accuracy, but a red line running across your chart is a place that could stop the market in an uptrend. It's a place that could create an untradeable bounce. It's a place that we're going to want to have break as opposed to trading into it. When the market is trending down, blue Fibonacci support has the equal but opposite reaction. It could stop the market. It could create an untradeable bounce, and you'll get to the point to where you will insist that area break before you choose to take another short trade. You'll also see yellow 1-to-1s. These are Fibonacci areas that print in the moment. These are 100% Fibonacci alternates. They're taken from a pretty good sized swing in the market, and these yellow 1-to-1s can behave as resistance if the market is trending up. They can behave as support if the market is trending down. Now for my TradingView users, you have triggers as well. Same thing. The only difference between TradingView and NinjaTrader indicators, guys, there's still divergence on TradingView. There's still 1-to-1s, mid-bands, but you're going to have zones as opposed to Fibonacci if you choose to go purchase zones. I use the Chart Prime indicator. I love their accuracy. They're great at predicting turning points because the market reacts and respects these areas because the market created these areas. So we know where they are. We know before the market ever gets there, you're going to learn to respect them. So when we talk about 3 rules, we're going back to NinjaTrader. We're going to stay on NinjaTrader for a minute. 3 rules. Each rule, when true, creates an advantage, and it's the 3 advantages that creates a trade for the brand new user. I'm going to stress that for the brand new user, for the new guy, for the person looking to win more than they're losing as they learn to read their indicators. So everything starts on the large chart, and the large chart needs strong triggers because strong triggers give me the advantage of momentum. I want you to think of your rules as a flow chart. If I have strong triggers, the advantage of momentum, then and only then will I look for my path. So let's define strong triggers. TradingView or Rinko, guys. Strong triggers is always strong triggers. It has nothing to do with areas. It has nothing to do with price bars. Strong triggers means that your smalls in an uptrend when the background is green have broken above and away from your large triggers. The space that's created between the small and large, I want you to picture scissors that are open. This is my favorite picture, and I think that it really helps. If you picture scissors that are open, right, or Pac-Man or whatever you want to call it, when the space between the small and large is present, same is true in a downtrend. When the background is red, when the smalls are red, when the large are red, space, open scissors, lets me know that the odds are favorable for the market to continue in the direction of the trend. Odds favorable momentum is what you're going to hear in the room all day long. You're going to hear strong triggers, odds favorable. OFM, you're going to see it on charts. And guys, odds favorable momentum pushes a market. Odds favorable momentum is what we look for to break those key areas when they need to be broken. Odds favorable momentum will even cover some of the mistakes that a new user makes, and it'll create advantages that a more experienced user will take advantage of. So strong triggers is nothing more than separation between the small and large. And let's just look at crude oil live. Smalls below the large, space between, and it breaks an area, and it breaks an area. And then look how the smalls are working their way back inside of the large. So momentum dies after a while, and that's exactly what it looks like. When your small triggers return inside of the large triggers, when your scissors close, ladies and gentlemen, you now have weak triggers. And weak triggers remove the advantage of momentum. Weak triggers, anything could happen up or down. And this is where you'll see retracements, maybe from seemingly the middle of nowhere. And this is the look when key Fibonacci areas are more likely to hold. So let's go back to a large chart. Strong triggers pushes a market down until it becomes weakness. Strong triggers push a market up until it hits a roadblock. Strong triggers push the market down. When it becomes weakness, that's when we see the retracement. Can you guys give me a why in the room? If you're with me, especially my new users, one of my goals for you guys is that you don't overthink it, right? It's either separation or it's not for a brand new user. But once you have momentum, guys, that market is going to be hard to stop. But there are things that can stop it. We call it termination conditions. So RK, big breath. If you have momentum, right, let's go through. The first rule is momentum. So if I have momentum, this is where those blue lines come into play, RK. I have to make sure that I have a clear path. I have to make sure that there's not something in the way that could spoil my fun, guys. So termination conditions are going to be horizontal lines on a large chart. It can be the divergence high, the divergence low. It can be Fibonacci support. It can be Fibonacci resistance. It can be a mid-band if the large triggers don't follow the move. It can be yellow 1-to-1. So any horizontal line on my large chart can stop the market. These are the areas where the men and women in control are making decisions. These are the areas where the buyers buy. These are the areas where the sellers sell. These are the areas where fights happen. So when we're defining a termination condition, guys, and we're going to talk about the when not to take that next trade look. The first step, and write this down, price reaches the area. What does that mean? That means that your dynamic Rinko bars in an uptrend found their way to Fibonacci resistance, found their way to a divergence high, found their way to yellow 1-to-1s. So when price reaches an area, guys, we're going to count triggers. You're going to count how many of the 4 trigger lines made it above resistance. Does everybody see that the answer is 0? Not one trigger line made it above resistance. Ladies and gentlemen, this is a termination condition. This is an area that could stop the market. This is an area that could create an untradeable bounce. This is an area that could break. You'll never know. You'll never know. You can't predict. So as the brand new user, rule number 2 says absolutely no trades into that area. From the area, the market comes down. The momentum is strong. Life is good. Maybe you found an opportunity there. And then it reaches Fibonacci support in yellow 1-to-1s. And we go right back to counting triggers. And the answer on how many triggers made it through the area is 0. And because it's 0, absolutely no trades into the area. That's a termination condition. So let's go look again. I love going back to a live market just to see what they did. Here, we'll make it like this. And this was a drill that somebody did yesterday that we talked about yesterday. And I want you to see this, how the recipe comes true. Price reaches Fibonacci, let's go here, resistance. The triggers don't break. That's the wrong stamp. Absolutely no trades into that area of resistance. It could create a bounce. It could create a fight. It could reverse everything. That's an avoidable loss. The same is true at support. If you got excited about momentum but ignored termination conditions, it resulted in a loser. Same at 1-to-1s. Up here, that was Fibonacci resistance. That was Fibonacci support. That was Fibonacci resistance twice. And now currently, the market is trading into Fibonacci support. And you're thinking to yourself, Mark, how am I ever going to make money if these damn lines are everywhere? Remind yourself, billions is what the market trades. This rule is based on thousands of pictures, decades of teaching people to trade. Fibonacci is strong, and it's uncanny how often the market affects and reacts. So to define the termination condition, guys, let the market get there. And if no triggers break, sit on your hands. Assume that the area will hold. If 2 of your trigger lines, now we're going to start talking about the potential to break because areas break all the time. If 2 of your trigger lines, 2 lines of the small triggers get above the problem area, get below the problem area, well, now the market has the potential to break. And that potential is just potential. It's not a clear path yet, which means if you're going through the process, you put yourself in a medium probability scenario. It's okay to lean on momentum, to lean on an entry area. Whoops, where did I go? I changed my picture. There we go. 2 triggers with momentum is the potential, but it's not the best look. When you begin to get 3 lines, both small and 1 large, above the problem area, now that potential is the best look. Now the breakout is more likely. But it's not until 4 trigger lines, both small and both large, get above the area in question. Guys, this is when the area is broken. This is when the path is clear. This is when life gets easy. This is when you can find the easiest trades ever, because the easiest trades will be taken away from Fibonacci resistance and taken before you reach Fibonacci support. And the easiest long trades will be after resistance breaks with momentum, trading to Fibonacci resistance. So there's going to be some waiting, there's going to be some pause, there's going to be some do nothing. But guys, we're going to teach you how to capitalize on those moves between the fibs. We're going to teach you how to recognize when you have momentum and when your path is clear, how to define an entry. So one more look at crude oil just for grins. Potential to break, only 2 triggers, did not. That's where your reversal came. Strong triggers push the market through. Hey, good morning. So, Ollie, it's up to you. I switched to the October contract just for ease. The volume is split, so you get to make a decision. For the classroom, I am on the most current contract. I am on crude oil 10. Can you guys give me a why right now? I don't have momentum. My small triggers are inside of the large triggers. Do you see it? That's weakness. Does everybody see what that 1 bar is doing with weakness? Let me show you the small chart. Inside of this one bar, ladies and gentlemen, this is like the coolest thing ever, are all of these bars. Inside of one bar is all of the bars, all of the refinement. My rule 1 isn't met, and guys, you can see on the smaller, faster chart exactly how the market is reacting. Exactly how the market is reacting. We're going to use this reaction, and watch this. We're going to use this reaction, this pullback, this bounce, this continuation, and that is how rule number 3 is going to allow you to reduce risk. That is how rule number 3 is going to allow you to increase your profit potential. So rule number 3 is very specific, it's very accurate, and rule number 3 says that your accuracy is so awesome that you're going to use a limit order. You're going to wait for the market to come to you. You're going to call your shots. You're going to be in control of whether or not you enter. And you're going to use that limit order to buy or sell a pullback, which means you're going to let the small crowd fight on that smaller, faster chart. And you're going to buy or sell that pullback right at an area, at a fib, at a mid-band, at a yellow 1-to-1. Because the same way these areas on a large chart can stop a trend, on a smaller, faster chart, we rely on them to create that bounce to go with the trend. But there's one word that is so important, and that word is triggers. Your area needs to be inside of triggers. And on your small chart, you have 2 sets of large triggers. You have the smooth ones. These are native to the 5-1. These are the ones that when you compare them to the small, let you know that you have that strong trigger look. And then you have the stepped triggers, and these are what we call synthetic triggers. And synthetic triggers are nothing more than the large triggers from the large chart. Pretty cool, right? So triggers will define the retracement. Price breaks away from triggers, and it tends to return to triggers. Price breaks away from triggers, and it returns to triggers. And this is true on both time frames. This is true on the large chart. Look at that, no momentum, giant retracement, avoidable loser. Sorry, I got excited. Trigger lines define the retracement. Trigger lines tell you everything you need to know about everything, guys. So when you buy or sell a pullback at an area, fibs, mid-bands, or yellow 1-to-1s, inside of triggers, what you're doing is you're trading a pattern that you can prove when the rules are met, wins more than it loses. So let's go through the entry process together. This will be fun. And I have to say, when the large chart rules are met, I can't stress that enough. When you have strong triggers, when there's nothing in the way, your small chart is going to be screaming north. And everybody's familiar with that nasty little term, fear of missing out, right? When your rules are met on a large chart, your FOMO is going to be full tilt boogie until you learn to trust this pattern. And you're going to say to yourself, they're going without me. I'm not getting paid. I hate Mark Novak. I hate Nexgen. How am I ever going to make any money? And then you get a reversal bar on that smaller, faster chart. Those fluctuations kick in. The small crowd starts to fight. And this reversal bar begins the pullback. Boogie, oogie, oogie. You know it. And guys, the reversal bar is not your entry. That's a loss of momentum. It's a little shift where the small crowd decides they're going to try to take over. We can know where they're most likely, where they might, where they could, where the probability lies, where they're most likely to retrace. And that's somewhere from the top of those large triggers to the bottom of the large triggers. Trigger lines define the retracement zone. But trigger lines aren't bouncy. Trigger lines are not brick walls. They're like clouds. We need something bouncy inside. Trades come from fibs, mid-bands, or yellow 1-to-1s. And guys, all caps inside of triggers. So you have a little bit of a range here. You have a mid-band at the highest point, closest to the reversal bar. You also have yellow 1-to-1s down there at the bottom. And let me go through the mentality of the entry. The market may retrace all the way to the bottom of those triggers. Is everybody with me? Give me a Y if that makes sense. It may retrace all the way to the bottom of the triggers. It's most likely to bounce at the highest point of support inside of triggers. But it could go to the lowest point of support inside of triggers, and it could, damn it all, just blow through everything. Right where you're going to be waiting with a protective stop if this isn't part of the 70 to 80%, if this is part of the 20 to 30%. So triggers define where the retracement's most likely to occur. Areas within triggers define where it's most likely to bounce. Because the large chart looks like this, strong triggers, nothing in the way, your job is to activate a limit order just above that highest point of support, closest to the reversal bar. This becomes your entry for the highest probability trend trade. This is the small chart pattern for the overall pattern. When there is momentum, when there is path, you guys can accurately pinpoint entries using the smaller, faster chart. And for those of you that are new to futures, did you know that when your 401k is suffering, you can make money even when the market goes down? And it's the same thing. The large chart will say down and down strong. The large chart will have nothing in the way to create a bounce. You're going to wait for the reversal bar, guys. 90% of your day is waiting. But when it prints, you will know without question where the retracement is most likely to go. Somewhere from the top to the bottom of the triggers. You'll know precisely where it's most likely to bounce, at the area inside of triggers. And you'll be able to say to yourself, because of those large chart advantages, I'm going to activate a limit order and I'm going to sell this market on its way up so that I can ride with the momentum on the way down. Anything beyond the triggers is not a part of the equation, guys. Anything on the wrong side of the triggers, above the triggers, this is where the advantage of rule number 3 is no longer met. And because you are able to define precisely where the market is most likely to continue, you have defined where the market should not go if this is going to be a winner. Management builds fortunes, guys. Giving away the least amount and putting stops where the edge is gone, where the advantage is gone. So if I enter at the area inside of triggers, then my initial stop is placed where the market should not go, and it should not go about 5 ticks beyond those triggers. If it does, I don't want to be in it. Once you get beyond the retracement zone, once you get beyond the areas inside of it, you don't know if, when, or where that market is going to stop. You don't know if, when, or where it's going to continue up. It's advantage over. It's okay to take a loss, guys. Small losses are a normal part of a positive equity curve. But what you can do is you can commit to the pattern. So this is your pattern. First, it's momentum, small's above the large. Then it is at least the potential to break, 3 triggers above trouble. Then it's a reversal bar, it's a pullback, and God willing, it's a bounce off of areas inside of triggers to take you to the next key area. This is your pattern, ladies and gentlemen. This is the look that you can study as a brand new user. This is the look that you can prove wins more than it loses. This is the look that's going to teach you to recognize the advantages that are going to take you to the promised land. That's why we talk about it each and every day. Are there any questions? Here's how you can study it. Does everybody see the momentum? Everybody see the path? If you circle a tail on a large chart, guys, it should pull back to an area inside of triggers. Whoops, my NinjaTrader crashed. Let me pull NinjaTrader back up. We're going to go do some stuff. So let me get it back up real quick, guys. This is what the pattern looks like. This is how you can study the pattern. By going back, whoops, roll crude. Let me get my connection. By going back on your large chart, and every time you see momentum, go back on your large chart. Scroll back historically. You don't even have to be in a trade to get good at this pattern. You're going to see clear path or potential to break. If you see one of these tails with the rules met, circle it. If it lines up with an area inside of triggers, ladies and gentlemen, that's your pattern. So if I see momentum, if I see the potential to break, let's see where that square shows up on a smaller, faster chart. Pulls back to a midband inside of the retracement zone and then continues down. This one had momentum and potential to break, and it pulled back right to the areas in the retracement zone, and it continued down. Pretty cool, right? There's your pattern again, guys. And then with weakness, I want you to see this, with weak triggers and with no areas inside of the triggers, but on the wrong side of the triggers, look what the market does. So the market repeats this process, guys, all day, every day. The market repeats this over and over and over. It is testable, it is repeatable, and I would say it's predictable. Are there any questions about momentum? Is it safe to place a reversal order fib support for resistance level? So RK, let me make sure that I understand the question. You're saying, hey Mark, if I have odds favorable momentum, can I just put a reversal order right there and hope things work out, right? RK, you can do whatever you want. And I guess that's the beauty of trading. I don't tell you guys how to trade. I don't tell you where to enter. I teach you how to read indicators to make good decisions. But RK, the biggest mistake that new users make is fighting strong triggers. Fighting strong triggers. And typically, if you're just jumping into a line hoping it holds, you're fighting strong triggers. And I want you to see something. If you embrace that idea, there's a loser, there's a loser, a loser, a loser, there's a loser, a loser, a loser, probably a loser. That one might have won for you, right? So trading is about probabilities. Trading is about advantages. Trading is about forcing the market to give you what it needs. Forcing the market to break out of that range that rule number 2 created. Forcing the market to give you the momentum that you're looking for, to let you know that it has the potential to break, and forcing the market to pull back to those areas inside of triggers. Do you guys see it again? Because that is where your advantage is. And this one, with separation and all the triggers below trouble, pulls right back to the area inside of triggers, and sure enough, it continues down again. So RK, you can do whatever you want. I won't stop you. I won't call the trade police on you. But there is a pattern. There is a way for you to have an advantage. There is a way for you to give yourself the best chance of success. And it's having momentum on your side, which means that you're trading with the trend. It's having nothing in the way, which means you're not trading into one of those lines. And it's defining your entry on a pattern that gives you the ability to manage your risk on that entry, guys. That is your core, and that is your foundation, and that is the very basics of everything that we teach in this room every day. From all of this, your ability to recognize advantages will open the door for more trades. So your first trade is the best trade, the highest probability trade. Your second trade relies on the potential to break without the clear path, and it gives you a very clear path to take that trade. Are there any questions about a high probability trend trade? And can I remind my new users in the room, your job right now is just, you're starting to learn a little bit of language. You're starting to learn what the indicators are called, what the areas are called. You're going to hear me say momentum and path, momentum and path, momentum and path. And for your first day or two, it's going to be a little overwhelming. It's a lot of information coming at you. I know this. I've been there. Focus on the basics. Focus first on learning the language, and then being able to identify momentum, guys. And once you're good at momentum, learn how to count trigger lines. And once you learn how to count trigger lines, you will be able to find your entries. And by about the third day, you're going to start seeing things. You're going to start seeing these patterns materialize over and over. So that's NinjaTrader, guys. And sure enough, do you guys want to do an entry together? Let's do an entry together before we head off to that other platform. So check it out. Is that synthetic? Yeah. I'm going to try and make this easier to see for everybody. I forgot where I was. Okay. Right here. So we're just going to do this. Large chart, guys, and we're going to go just like this. Rule number 1 says, let's identify momentum. There has to be breathing room between small and large. Does everybody see that the small triggers are below the large triggers? The trend is down, and there is, in fact, space between the two. And I like this example because some of you are going to say, well, is it enough space? Guys, if it is space, it is strong. Rule number 1 is met. Rule number 2 says I have to be below trouble, guys. This divergence low stopped printing 2 bars in the past, which means that I'm below anything that could create a problem, and I have momentum, and I have not reached my next problem. Give me a Y if you see that this has momentum and a clear path. It's time to look for an entry, ladies and gentlemen. And now I'm done with the large chart. So on my small chart, I'm terrified. It's going without me. It's going without me with the momentum. It's dropping like a ton of bricks, and I'm not making money. But let's go and wait for the sequence. So rule number 1 for entry says wait for a reversal bar. And guys, while you're waiting for a reversal bar, does everybody see where the triggers are? Before I ever get a reversal bar, ladies and gentlemen, I know that if it happens, it's most likely to return to these triggers. I know that if that reversal bar happens, it's most likely to bounce at that area inside of triggers. Did you know that I could just go ahead and set up for success, anticipating the reversal bar? Pretty cool, right? But it doesn't always come right then. So the market continues down. And I glance up and I notice that now my triggers have gotten lower. And I have 2 areas inside of those triggers. But I still don't have a reversal bar. I'm holding tight, guys. I'm holding the course. I'm staying true. And then, boom, there's the reversal bar. And from the reversal bar, there's the bottom of my triggers. There's the top of my triggers. Does everybody see it? That's where the market is most likely to retrace. And guys, this isn't me hand-picking. This is me just following rules. From the lowest point of resistance to the highest point of resistance inside of triggers is where this market is most likely to bounce and continue down with momentum and path. Can you guys give me a Y if you're with me? I'm going to right-click on my chart, guys. I'm going to call my shot. And I'm going to activate a limit order, a tick or 2 below that lowest point of resistance. Right, Victor? 64.92.50. So we'll do it. We can do it 1, or you can do it 2. Either one. I'm going to do 2. Guys, if we get an entry on this trade, my stop belongs up here, about 5 ticks beyond the trigger. So not only do I know exactly where I'm going to enter, I know exactly what my risk is going to be. Now the only thing I need is for the market to play along with me. I've done everything I can do. I have insisted, I have insisted on momentum, and I just lost my picture. Here we go. I have absolutely demanded that the market give me strong triggers. I was adamant about the fact that my path would be clear, and I was able to define beautifully where the market was most likely to continue by using an area inside of triggers. All it is a pattern. And the market comes back, and it puts me in the trade at 69. 64.92.25. I have defined my entry. I know exactly where my stop goes. From 93.50, I'm about right here. That's where my stop placement's going to be. Now, in the KISS plan that I gave you, there are targets. There are predetermined targets. One of them is going to be at 60.25, 90.25. 8 ticks away, $100 worth of distance. The next one is going to be, should be 89.25, 88.25, 88.25. That's a $200 target. $100 target, $200 target. Guys, this is all outlined for you on the KISS plan. This very methodical. If my entry is 2 ticks below resistance, then my stop is 5 ticks beyond the triggers. Let's see what happens. The market goes against us, and my palms start to get sweaty. Whoa. And the market goes against me further, and I'm looking at red numbers, and I feel like I want to throw up. And the market goes against me even further. And guys, now I'm sucking a pleat into the middle of my leather chair. It's going to be difficult to remove. But I want you to see something. I'm still in the retracement zone, and I'm still at the areas inside. My advantage from rule number 3 is still in play. And the market goes against me again. Son of a gun. This might be the worst example ever for a live classroom. And then it goes against me again to the top of the retracement zone. And again, and whoa. Now it's going in the direction of my trade. And it didn't hit my stop. That's the reversal bar. Now it's confirming that it's going down with momentum, that it's going down with a clear path, that it's going down from the areas inside of triggers. My new stop is 2 ticks above it. That's my new stop. You don't know how you just made 1,500? That's a hell of a good accident, Robbie G. Bag. Post a picture of it. Let's talk about it. So guys, confirmation bar. Now we're in the good, and it goes down, and it goes down, and down, and down, and down. And now I've got $100 in the bank. And nobody can take that from me. I just made $100. And because I made $100, because I'm in the bank, I'm going to move my stop to break even, guys. I'm going to take all the risk off of this trade with the hopes that my large chart continues down with all that momentum, with that clear path. And if it does, congratulations. That's a $300 trade. That is $300 in your wallet, $300 in your account, $300 that nobody can take away from you, and you followed the most pragmatic, emotionless plan you could ever follow. Ladies and gentlemen, welcome to Nexgen. This is the pattern that we talk about every day. These are the advantages that get you into that trade. Here's a way to manage it as a brand new user. Now I'm going to remind you guys something. $300, that is not your day. That's 4 minutes of your day, guys. But if you shut it down and that's the best you did every day, you're on path to a $75,000 year. Now, if you find a way to add $100 each day, you're in 6 figures based on $400, based on 1 trade with 3 rules on only 2 charts, giving you the highest chance of success. And Ollie just said it. Follow the rules. Using this system is amazing. Amen. Guys, we've been teaching people to do this for 28 years. For 28 years, we've been teaching people to just find advantages and make it happen. All right, so Robbie, I don't know where you entered, right? Have absolutely no idea. But do you want to see something amazing? And Robbie, is this your first day in the room? More than anything, welcome to Nexgen. No, you're good, man. Do you see strong triggers right there? Does everybody see it? Smalls below the large. Does everybody see that 4 triggers are below resistance? Hey, Robbie, what do you say we take your look that you just dropped in the room? No. Is it possible that your look was the entry that we just took together in the room? And you said you made $1,500 with momentum and path? Congratulations, Robbie. Day 1, you're already an expert. Day 1, you're already trading with the trend. You're already going with momentum. And once you learn how to define this entry, you got in at the top of the pullback with nothing in the way to stop it. Congratulations, you are already a believer. That's what we do every day, guys. Every day. Pretty awesome, right? So if you can't do it on day 1, it's cool. I'm going to say the same thing tomorrow, and Tuesday and Wednesday and Thursday and Friday, and it's going to be the repetition that creates recognition. And guys, as you go on this journey, it's all right, Siva. There will be a million of them. Guys, when you go on this journey, if you are a Ninja Trader, take this spreadsheet and you can click on these pictures and look at this. And this is random. Hopefully it comes up. There's a couple dead links. First it's momentum, then it's a clear path, then it's a pullback to an area inside of triggers. So Siva, welcome to Nexgen. It's absolutely wonderful to have you here. Momentum, room to targets. Doesn't this look exactly like what we just talked about, guys? Who wants to see something cool? If I blow this up, look at the date in the bottom left-hand corner. 2023. The same pattern was happening in 2023. Let's see if we can go back even further. Momentum, potential to break, pull back to area inside of triggers. 2022, ladies and gentlemen. 2022. The exact same pattern. 3 years ago. And I don't even know what market this is. I think this is the S&P, trading in the 3,000s. And it's the same pattern. And Brian, you could not have said a more true thing. I trust the pullback to areas inside of favorable large triggers because on my large chart, I've got all the momentum in the world. That's why we define momentum on the large chart. On my large chart, I have nothing in the way to create a bounce. That's why we trust the large chart. Guys, the small chart is just an entry chart. It's a way to capitalize on the large chart advantages. So when you're looking at the small chart, the large chart is absolutely a freight train to the downside with the potential to break. This is just a little fluctuation inside of that one bar, Brian. That's why I am selling on the way up. Because the large crowd typically wins. The large crowd has everything behind them, the money, the influence, the charisma, and they typically win. And I know exactly where the small crowd is most likely to fail thanks to rule number 3. Does that make sense? Do you know what the hardest thing in the world you'll ever do as a new user? Is put a buy order in when you believe the market has reversed. And this is why it is so important, guys. This is why it's so important that you remember that advantages come from one bar on a large chart. Momentum and path. Whoops. And inside of that one bar was 32 flavors of shenanigans, guys. There was a retracement. There was a bounce. There was a try to push back up. There was another bounce that ultimately did everything the large chart said it was likely to do. Does that make sense? Once you learn to trust the large chart, activating that limit order becomes effortless. It becomes effortless. Weak triggers, no areas inside of triggers, you can see the dance. So guys, I'm going to take 2 minutes real quick. When I come back, we're going to go over TradingView. When I'm done in TradingView, We're going to look at every chart presented in the room. We're going to talk about every chart presented in the room. And we're going to keep going back and forth in the live market and just kind of looking and reading and seeing what it says. And Ron says that it is red news in 2, guys. Let's leave it on the S&P. You can watch the reaction. I'll be back in just a minute. We'll get going. Let's get into TradingView now. But before we go to TradingView, newer users, I want to remind you that this is day 1 or day 2 or day 3, and I don't want you to put the pressure on yourself to be perfect in the beginning because it's a lot. I know it is. You got to learn some language. So I'm going to give you guys this document right now. So if you're a brand new user and you've got to go away on the weekend, this is how I teach every day, guys. We talk about 3 rules on 2 charts. We talk about the recognition of advantages and then turning those advantages into a trade. And the class is consistent, guys. I've been saying the same thing for 5 years. We talk about momentum and clear path. These are the core. These are the 2 concepts that are going to open all the doors you could ever hope to have open. But until you have these concepts down, this document gives you the rules. It shows you where they're found. It gives you the indicators that you need to make sure that the rules are met. Talks about momentum, how to recognize it, clear path, how to recognize it, entries, how to pinpoint it, go through it, get your order in place, and also how to study. So everything that you need to be successful with the software, with the exception of the repetition, can be dropped down into 2 pages and about 20 pictures, guys. So keep it simple, keep it focused, learn how to get paid. Odds favorable momentum, nothing in the way. There's a pullback to an area inside of triggers. First target's at $100. There's my reversal bar. I'll reduce risk 2 ticks behind it. If my first profit target is reached, I'll go break even. If my second profit target is reached, it's a $300 trade. Does everybody see that big fib right there though? I didn't have that set up on my chart. But that's it. It just happened live. And we have nothing to lose. We've already made money. We've already been paid. I can see the thing that could create trouble. You can see it's still going while my chart calculates. Let's see if it hits the second target. Can everyone give me a Y if you see the momentum? Can everyone give me a Y? Well, we traded into a termination condition, guys, but we didn't see it at the time. Pull back to an area, target reached, and guys, in a normal world, you would adjust that second target to get paid right at the area that could cause trouble. Guys, this is what we talked about all day. You're just spinning, Victor? Here, let me reload it. There you go. Can you guys hear me? Give me a Y if you could hear me. Okay, cool. Guys, it's not, and Pete, I'm going to disagree. It's not the best chart look ever. Does everyone see resistance without the triggers above? If you took this trade, you traded into a termination condition. But because you knew it was a termination condition, because you studied that simple rule, you got paid right at the thing that could mess up your good time. Guys, that was $250 live right in front of you using that same darn pattern. And look what happens. Put the square at the bottom of the tail. We don't trade the tail. We trade pullbacks to areas inside of triggers. Guys, I will fight you in the streets if you tell me that this doesn't work. It does. Your job is to learn how to work it, and that's exactly what we just did. All right, we're going to go to TradingView now, guys. Woo! TradingView uses minute bars, not Renko bars. So you have to think about things just a little bit differently in TradingView. Do not try to trade TradingView the way you trade NinjaTrader. Guys, do not try to trade NinjaTrader the way you trade TradingView. They're different. 15 minutes is a long time to create a bar. I haven't reviewed anybody's trades, Ollie. I have not reviewed anybody's trades yet. We're going through rules. I've got a lot of new users in the room. So I'm kind of slow rolling and going through. I never forget about you. Sometimes I miss it, though. Sometimes I miss it. Awesome, RK. So thank you for telling me, because I have been known to miss a trade every now and then. Guys, these charts are big, and these charts are slow. Ollie's good. So bet entries come from the 5-1. Great question. Entries come from the 5-1. So let me give you this picture, guys. Remember where your rules are met. Your large chart will give you momentum. Your large chart will let you know that the path is clear. And then it's that refinement process bet on the smaller, faster chart that gives us the ability to pinpoint exactly where the market is most likely to bounce. So large chart says, hey, let's look for an entry. Small chart shows us exactly where that entry comes from. Does that make sense? Great question. Those are the best questions ever, guys, because bet you're not the only one that was wondering. I guarantee it. All right, guys. The TV plan, the TradingView plan, you guys on TradingView, and just a heads up, if you didn't know, Nexgen for new funding company users is giving you a $50,000 evaluation to get you in to test your metal. So here's how you're going to beat that evaluation. Remember that the 15-minute chart leads the way, that the 15-minute chart is your roadmap for key targets. It's your roadmap for turning points. It's your roadmap for termination. And the triggers on this chart are going to let you know whether or not you have the advantage of momentum. Your 1-minute chart is the immediate strength, guys. This is not Renko. It's not the same thought process. This is the immediate strength. This is entry points. You're going to take entries from mid-bands for trend trades, HVA lines coming from areas that stop the market, and HVA lines in zones and areas for the momentum trade. So there's 3 trades available to you on TradingView. There's the trend trade. It's only got 3 things. There's the HVA trade. It's only got 3 things. There's the momentum trade. It's only got 3 things. How easy is that? 3 things on 2 charts. Now my TradingView peeps. Momentum's a little different because of the 15-minute chart, guys. So you will have small triggers and you will have large triggers. But because of the speed of this chart, your small triggers are going to tell the story. Your small triggers are going to help you decide which way you should be going. Nope, Adriana, absolutely 100% free. No fee for the evaluation. Pass it, goes to semi-live. You can get paid on an account that you never paid for. Sign up. It's not for NinjaTrader. It is not for NinjaTrader, though. You need TradingView. Go to the funding company site, guys. New users, free 50K coupon. Ba-boom. And we're going into the rules for trading that one. Of course it is. It's new, right? It's new. Math confused the hell out of me. It was new. It still does, but new things are confusing. That's why we take time to learn them, right? But it's worth it. But it's still adapting to the Prinko. Right on. So guys, how to read your 15-minute chart. A short story by Mark Novak. What direction are my small triggers not growing? Every time I look at my large chart, the first thing I look at is my small triggers. Does everybody see that the triggers are going down? My small triggers are pointing down. They're dropping out of the sky, dive bombing, whatever you want to call it. My thought process is I'm just going to go down with them. My small triggers are going to tell me which direction to go. My second question when I look at my large chart is which side of those triggers is my current price. So my current price, highlighted right here. We're in the number 3, guys, which means that I am above small triggers that are pointed down. This is the weak side of triggers. The weak side of triggers means everything needs to be in favor of this trade, that I'm not fighting anything on my 1-minute chart, and I'm going to be hyper aware of 1-minute zones and areas that can create a bounce. If I am inside of the triggers, transition. And it's transition because it's transitioning from strong to weak. Same thing. Only looking for short trades, going with the trigger lines. But in the transition, I'm still looking for the shorts, but I'm still going to manage assertively. Areas are more likely to create troublesome bounces from the transition. Now, if I'm left of the triggers, this is the strong side of the triggers. This would be the equivalent of having odds favorable momentum on a Renko chart. When I am left of the triggers, this is when those 1-minute zones are more likely to not be problematic. When I'm left of the triggers, this is the easier shorts. I'm still not going to fight the small chart, but this is where bigger moves happen. This is where 1-minute zones tend to break. So I'm going to say, what direction are my small triggers? Where am I in relation to the small triggers? And then finally, the most important question, is there anything in the way? I'm going to define my path, guys. On TradingView, you have divergence highs that can stop the market. You have mid-bands and yellow 1-to-1s and pink 1-to-1s that can stop the market. You've got zones that can stop the market. Pretty cool, right? Same stuff as NinjaTrader. The only difference is that it's zones, not fibs. So when I go to the live market, I'm going to ask myself, What direction are my small triggers trading? Let's just freeze the market real quick. Does everybody see that the small triggers are down? TradingView users, play along. Give me a Y if you see it. The smalls are down. Where is price trading in relationship to the triggers? I'm on the weak side. I'm on the weak side of them. This isn't the easiest shorts. Let's make sure that the small bar is better. But here's the big question. Is there anything in the way? I see one-to-ones here. We've already reached support and we're headed the other direction. So there's trouble beneath me. If I'm going to take a short trade, I can't fight strong triggers. If I'm going to take a short trade, I can't trade directly into areas, and look how it just held over and over and over and over. If I want to take a short trade and have the highest chance of success, I probably want to get back below that thing that could create a bounce, that thing that sent me to the weak side of the triggers. And then it'll be easier to trade with the trend and direction to get back to trouble. Does that make sense, everybody? So first, it's where are my triggers? What direction? Where am I trading? Is there anything in the way to ruin my good time? Here the triggers are turning up. Do you see it? Which would put me on the strong side, but I don't have anywhere to go. I'm directly into trouble. 90% of your day, ladies and gentlemen, is doing nothing. Look at how trouble is held. 1, 2, this is our third shot at it. Look at how trouble held below. 1, 2, 3 times. Caught in a little bit of a range here, and if I'm not mistaken, even your Renko bar charts are saying you're caught in a range here. Nice short, Victor. It's the same concepts. What do my triggers say? Where am I in relation to my triggers? Do I have room to get to something that's creating problems? So when we talk about TradingView, guys, there's 3 trades. Here they are. But there's 2 entry looks. And we're almost done with all the rigmarole, guys, and we're going to get on to reading charts. There's the trend trade entry look, which means that your large chart is 100% in favor of going long, but your small chart, small triggers, fast triggers have turned against you. This is an immediate momentum. When they turn against you, your best bet, your highest chance of success, comes from letting the market pull back to an area, to a zone, to a mid-band, and then waiting for the close on the correct side of the triggers to go with the large chart. If you fight the triggers, you're more often going to lose than win. So entries come from a close on the correct side. That's your trend trade look. There's another look that's called the momentum look. The momentum look means that your large chart is down, that your large chart has nothing in the way, and your small chart, does everybody remember the strong trigger look? Smalls below the large, everything down, space between. With this look, and the large chart supporting it, you will sell. You will activate a limit order right at that zone because of the momentum, because of the clear path, and this becomes your entry for a momentum trade. The only way we're activating that limit order is with strong triggers. Otherwise, we're waiting on the close on the correct side from an area. From an area is a very key phrase. So when you look at the KISS plan, or I'm sorry, the TV plan, a trend trade, the 15-minute is not trading into anything. The 1 minute is not trading into anything. Buy or sell a close on the correct side of the triggers. For the HVA trade, a zone is reached on the large chart. The 1 minute chart rolls to go the other direction. You can buy or sell a pullback. And then there's that momentum trade. Everything is strong. Buy or sell a pullback right in an area, guys. So these are your plans. Both have been given to you. You have both spreadsheets. Now it's time to start putting into practice. Now it's time to post in the room, to get a little feedback. So I'm going to scroll to the very top of the room, guys. Are there any questions, TradingView users? Please put them in there. And I'm going to look at what you guys have presented, and we're going to talk about what you've done and what you see and the words on your charts. And I'm just going to give you feedback on everything that you've presented. So scrolling up, scrolling up. And I'm not going to get into yesterday because you guys had awesome conversations for hours yesterday. And I'm not going to sift through all that. If you posted something yesterday you'd like feedback on, please do me a favor and drop it in the room. Pete got us going today. And Pete says, look at this. Opening trade of the day, weak top, which means that it wasn't a termination that reversed the market. It just kind of arbitrarily didn't break the area and down it goes. Odds favorable momentum. Everything is down and it's below trouble. Do you guys see momentum and path on Pete's chart here? Pete says, I'm not going to take the trend trade. And I don't know why he didn't take the trend trade. That's not my business. Pete says, let me get below anything that could create a bounce. Let me get below a decision-making point with momentum and path on my large chart. And I will ride that momentum all the way down to trouble. Missed his second target by a tick. So when he got to the weak side of small triggers, he took an exit. And Pete, this is outstanding usage of momentum and path. Does everybody see it? It's not a trend trade. He just jumped the fudge in. Why? Because, you guys are going to get so tired of me saying this, because he had momentum and path. Because he had a market screaming south with absolutely nothing in the way, he found a way to pull money out of that market. Great job, Pete. All right, back up top. And I know Jen had to leave. She's going to have to catch this on YouTube. But we're going to go through because Jen put a lot of great trading view charts in the room with some good analysis, as did Paul. So I'm going to open a few different charts here. We're going to start with Paul. And then I'm going to open 3 or 4 behind it so we don't have to push back and forth. New users, I want you to pay attention to the annotations on the charts. I want you to pay attention to the wording. Pay attention to the questions. Pay attention to how they don't just drop in the room and say, hey, look what I did. It says, hey, Mark, price keeps trading inside of triggers. That's transition, right? That's transition. And you're absolutely right, Paul. Where your arrows are would be considered the transition side of the market. But look at where price is actually trading at the very bottom. Do you see it? Guys, when you're deciding on strong, transition, or weak, one thing you can do in a short trade is draw an arrow, whether it's in your mind or with the drawing tool. And Paul, right here, I'm on the strong side of those triggers, right? And if I pull back a little bit, it'll be on the weak side, or in the transition side. Does that make sense, everybody? This 15-minute chart is where is price right now? Strong side of the triggers, Paul. Good picture. Great question. I encourage all of you guys, if you have a question, take a picture of your chart, point it out. Let's make sure that you're getting what you need from the room. All right, Miss Jen says, small triggers down. It is the weak side of the triggers. She has strong triggers on her small chart, and she sells a pullback to the zone. And she sees trouble, and she gets paid at the zone. There's your momentum trade. Nicely done, Jen. And now here is a very common mistake. The rules say, and I'm going to go through this, the rules say that for a momentum trade, the area breaks, price pulls back to that area. That's your momentum trade rules, guys. Which means that if you're going to sell this zone, your price bars, you want to see a price bar complete below the zone and then pull back to the zone. Can you guys give me a why if that makes sense? close. They're close, Victor. You'll get in tune with it. Which is the small, which is the large. The small, Victor, is going to move faster, right? Your large trigger, and I don't even have a large trigger on my crude oil chart here. Your large trigger is going to move slower. That small trigger is going to zip and bend and bounce. You'll be able to see it, no worries at all. All right, so I want to go back to why this isn't a momentum trade. And why this is. Do you guys see that bar that broke below, that finished below the zone? Does everybody see that? It got below, it's not touching it. Price cleared it. And then it pulled back to the zone. And then it continues down. Does that make sense, everybody? When resistance or support breaks, it behaves as the opposite. So when support breaks, here it is behaving as resistance. That's the big look. When resistance breaks, it behaves as support. And we use that idea. You need another monitor so I can have Discord open. Big on it, right on. They're cheap. Monitors are a dime a dozen. You know what else you can do, Victor, if you're feeling especially cheap? I've done this one. I did this for my wife. Go to Goodwill and buy a 32-inch TV for 20 bucks and just plug your HDMI right into it. It works out awesome. All right, guys, so we are going, I want you to see this, and I'm going to try to make this a little bigger for you. And there's a lot of noise on this chart. Does everybody see how price broke below this zone? There you go, Victor. But it didn't get a bar below this zone. This zone broke. This zone did not. Can you guys give me a why? If you see it, I'm trying to make it bigger. And I want you to see what happened. Which zone did price pull back to and continue down from? The one that was broken. I took a picture of this the other day, and I'm going to find it. Oh, I just had it. Where did it go? This is a very common mistake because we get excited about taking a trade. It's tempting to jump in when the price bar peaks below. You guys know who you are. I know who you are. You can't wait to jump in as price peaks below. But this is a pattern, like every other pattern, that retracement is what's most likely to happen. And then it continues down to treble. Does that make sense, everybody? Let it break and then pull back. If it's just peaking, it's not broken. I'll drop this one in the room. That's going to pay dividends for a lot of you guys in this room. The white horizontal lines print with our indicators on TV, or is that something Jen has? Are you talking about the white horizontal lines on the bars? Victor? So this is market flow. You'll have a market flow chart on your 1-minute chart. Each of those, that pair of horizontal lines, that is the highest volume of sellers in the down bar. That is the highest volume of buyers in an up bar. And the way this will come into play, Victor, is that if you get one of these breakout bars to the downside, and there's your highest volume of sellers, actually it was this one right here, breakout bar to the downside, when it's confirmed with a down bar, Victor, that's what creates your HVA line. These HVA lines become entries when you have momentum. It's a lot of noise for the new user. You can drown out the noise a little bit if you want. It's volume. That's all it is. It's a volume bar. That's what market flow is. Pretty cool, right? And as you guys get a little more advanced, we can go further into that. No worries. And Hunter, I can give feedback to her later as well if she shows back up. All right. Large candle from a zone to a zone. I posted this earlier. You guys love candles. You guys love the word candle. It's a candle. It's a big candle. It's a giant candle. It's an engulfing candle. It's an angry candle. Guys, I don't teach candles. Let's go through it. Triggers are down. Price is on the strong side of the triggers. Let's zoom. There's my bar that broke below the zone. Nope, I think we have to go up a little. Don't have momentum. Dang it, maybe there wasn't an entry. There it is, right there. Sorry. There's my candle that breaks below the zone. There's my pullback to the zone. There's my continuation all the way down to trouble. Guys, this is a momentum trade. This is a momentum trade. Everything is down. Strong side of the small. It's below the trouble. It breaks. It pulls back with odds favorable momentum. It continues in the direction of the trade. So was there an entry? Absolutely. And the key to your entry, ladies and gentlemen, I'm going to say it again because I think this is going to pay dividends. It's the bar that finishes below trouble, that turns resistance or support into resistance. It's the pullback to that area of resistance that sets you up with those strong triggers. Great stuff. And then finally, the zone is reached. The smalls get above the large. You take a pullback right to the HVA line. So Jen, your entry was 91-ish, not 94. And it didn't work. But Jen, this is the perfect HVA trade. This is taking a shot at catching a reversal from an area. And let's go through wrong trading plan. If I open up the trading view checklists, the HVA trade says zone reached on a 15-minute chart. 1 minute small triggers get above the large. Buy or sell a pullback to the HVA line. It fits the rules 100%. And it didn't work. Pretty cool, right? It didn't work. Smalls down. Price, well, currently, price is on the strong side, Todd. Up here, it was on the weak side. No terminations on the large chart. Price recently hit 1-to-1s. And red fib area on the small chart. Entry was the red arrow. Close below, right? All right, I like it. So let me just point one thing out. When I'm on the weak side of down triggers, that zone is more likely to create a bounce. That's all it is. Your entry makes perfect sense. And then it dances, and then it dances, and they push just a little bit higher. And then when they finally close again, that's when it really launches. That close, do you notice that it is below the trouble? That it's back on the good side of things? And this is some patience, guys. It's an ugly dance, and then it finally closes below, and that's when it runs. And it stinks when the market does this. It really does. It stinks when the market does this. But this is normal. Sometimes the market consolidates. Why? because decisions are made at key areas. And when I'm on the weak side of triggers, those key areas are more likely to create ugly little bounces. Does that make sense, Todd? It was a great read. Great read. And I think that understanding where the market is in relation to those triggers gives you a better understanding of the likelihood of these areas to hold. Because look what happens when you get back to the strong side and you reach this area with strong triggers. Just decimates it. Blows right through it. Pretty cool. How are HVA lines formed? I like it. Hey, Tom, it's good to see you in here, by the way. Let me show you guys how HVA lines are formed. And let me just make this really big. This is a breakout bar to the downside. See the magenta arrow on top of it? Hey, Carlos, welcome to the room. Great to have you. This is a breakout bar to the downside. Tom, inside of that bar, as evidenced by these two horizontal lines, that is the highest concentration of sellers. Guys, you don't need to know that, but we're given some nuts and bolts here. When a breakout bar down is confirmed with another down bar, you'll see that highest concentration of sellers visually as a pink line. You'll see the highest concentration of buyers visually as a green line. And here's what it means to you guys. It means that after confirmation, if the market pushes down and has strong triggers, if the buyers fight and come back to that area, it's not the breakout, it's the confirmation. If your sellers come back, your buyers come back, here, we'll make it green for the buyers. The sellers drew a line in the sand that said, hey, if you have momentum and you come back and test where we made everything go down, we're more likely to continue down right from that key area. And guys, that's your HVA momentum trade. That's using this HVA line when the rules are met is the key. When the rules are met. But let's see how they react. Just for grins, the trend is down, or small triggers are down. We're on the weak side of the small triggers. We have strong triggers. It pulls right back to the HVA, and down it went. Pretty cool, right? When does it stop printing? When it's no longer needed. See how the green one stopped printing when the pink one takes over? So there's rules that are met, and it has to do with either price or triggers getting back below it or back above it. There's another pullback right to it. And once it gets below the green, Tom, it goes away. Good question. So guys, if your plan said with the triggers down, with room to trouble, with strong triggers, sell the HVA line at 51, it made it 13 points before it even hesitated right at the trouble spot. That's $260 per contract based on following rules. Remember we said if you're on the transition side, things are more likely to create a bounce? And they certainly did, didn't they? Guys, it's repeat and rinse and repeat, rinse and repeat. Carlos, new Carlos, welcome to the room. What platform are you on? Are you on TradingView or are you on NinjaTrader? And same question for everybody new. John, take care, bud. Same question for everybody that's new. Are you on NinjaTrader or are you on TradingView? If you let me know, guys, I'll make sure that we get you the lessons that you need. We'll make sure that you get what you need. And if I have to run class a little longer, I don't have a problem with that. I'm going to click on a few more charts that were presented, guys. I'm going to try and get as closer to the bottom. I believe I can fly. So a couple more for Miss Jen, who's learning TradingView and asking for feedback on everything that she sees. Which is amazing. That's how you get to where you want to be. So let me jump back down here. TradingView, switch from Ninja. Awesome, Mike. Mr. Paul, you're on TradingView. Beautiful. Carlos, TradingView. Awesome. So when we talk about TradingView, guys, and either one, large chart leads the way. I can't stress that enough. Large chart leads the way. So let's look at another trade here. Price reaches the zone. And Jen sees the HVA line, but the small triggers aren't below the large yet, which means technically there is no trade. The rules aren't met. And then, sure enough, that was that pre-market spike. Strong side of the triggers, everything said down. No rules met, unfortunately. Actually, that little bar right there was your close below the small triggers, just below the zone with the large chart. And look at the spike and look where it stopped. That's what she pointed out. Guys, we're not the only people that know about these areas. Look at it here. We knew about the area. We knew about the area. The easiest trades come going from one side to the other. For my TradingView new people, I hope you got your free $50,000 account too. Here's the trade journal that I give out every day, and inside of that trade journal are the looks of the trades that are on this plan right here, the TV plan. So what you have is a journal that shows you what an HVA trade looks like. It shows you what a trend trade looks like. It shows you what a momentum trade looks like. It talks a little bit about management, a little bit about things that could stop your forward progress. And then all of these pictures are just descriptions of the 3 different trades that are taught. And in the TradingView plan, that's just the checklist. In the TradingView plan that I present in the room, guys, it reminds you where to find your entry, or where to define the overall, and how to define your entries, and where entries come from. And this class is taught with the premise that repetition creates recognition, that the more you see something, the slower the market moves. The more you see a pattern, the easier it is to catch that pattern. And that's all we do in this room is we talk about patterns. We talk about having advantages. We talk about things that are difficult to stop. And we talk about things that can cause trouble. And we do it just repeatedly, day in and day out, until it becomes easy. And guys, that's what we do in Nexgen. And if you're brand new with me, if you are brand new with me, and you are going after one of those funding accounts, here's the deal. I'm a part of the company. I'm going to do everything in my power to help you pass that evaluation. I'm going to do everything in my power to help you get to where you want to be so that you can pass that evaluation, so that you can trade my money, not your money. It's not really my money. It's Nexgen Pro Traders, but you know what I mean. All right, 8 ticks, dropping in the room. And guys, here's the second part. You guys that are new to the room, you'll get feedback on everything that you do if you promise to tell me what you saw. So, seen this pattern 100 times, so you took 2 positions and let it ride. So what we have here, 8 ticks. And let's go through the whole process and use the language. Check it out. This is what we call a weak bottom. And why is it a weak bottom? It's a weak bottom because your trigger lines get through the fib. Does that make sense? So there's two types of bottoms and tops. There's a weak bottom or there's a strong bottom. And a weak bottom means that trigger lines got through the trouble. So 8 ticks, when you have a weak bottom, only 2 triggers through is less likely to work. This is an iffy breakout. Does that make sense? I want you to see how this gets you right to your brilliance. You had momentum, you had the potential to break, and you took what can only be described as a beautiful momentum trade, hoping that the market continues up with momentum and that the area breaks. I love everything about the trade. I could show you the rules for it right from the trading guide. This is a Nexgen inspired trade. It's perfectly executed. Not every trade wins, right? So when this trade fails, and you might have jumped the gun just a little bit, when it doesn't continue up, right, and it comes back down, and those small triggers roll, and they start to push down, and you're like, dang it, that's not working. Right here, where it starts to break and then pulls back, that's the same trade. That's your apology trade, 8 ticks. You caught it a little early. You caught the apology just a little bit sooner. And when it fails, because of the weak bottom, what you did is you're on the strong side of those small triggers that rolled, and you rode it right back down to trouble. It's not a terrible trade. It's not a high probability trade because you're fighting momentum. It's not a high probability trade because you're fighting direction. But 8 ticks, what it is it's an understanding that from a weak bottom, the potential is less likely to work. And when your small triggers roll over and tell you that you're losing momentum, you take the apology for it not breaking that area. Does that make sense? Guys, remember, I can read your charts, right? So what you might do, 8 ticks, is put this trade into your spreadsheet with some annotations that say from a weak bottom, potential less likely to work. When it fails, I can look for an opportunity, we'll just say for an op, from strong side of small triggers for the apology. And now what you've done is you've written out a plan that turns this from being a terrible trade into a trade that you can test, into a trade that you can prove wins more than it loses, into a trade that has a very specific pattern, and it may just change your plan, right? That might be another trade in your plan because now you can define it and you can repeat it, which means that you can test it. Great job, 8 ticks. Thanks for posting that. Guys, I can read your charts. That's why annotation is so important because you're literally writing a recipe for success. You are literally saying exactly what happened to make you do what you did so you can repeat the process that's putting money in your account. That was a great example, 8 ticks. All right, Pibbies. Boom, boom, boom. I found that isn't much to tendency because I'm looking for little points as double. I don't know what that means, but let's take a look. Small triggers are down. You're coming from a termination condition. Price pulls back to the small triggers from the termination condition, and you're looking to ride it down to support. Pibbies, you have latched onto a trade that Nexgen started teaching in 2004. If Fibonacci resistance holds, let the small triggers roll, sell the pullback to the small triggers. Not a high probability trade, but once again, guys, it's an outstanding way to use the software and the read. Nicely done, Pibbies. All right, Todd, I love your annotations. And we covered this one, right? We did cover the talk about this one. You just posted it twice. Guys, don't ever be afraid to post twice. If you think I missed your chart, always post it again. Let me know. I don't want to leave anybody out. But I think we had a great conversation on this picture. So I'm going to scroll up. And, all right, Victor. And I love it. Victor, you love the play-by-play. So I'm going to get all three play-by-plays. Make sure there's not another one. Cool. All right. Victor says, I don't know what Victor's voice sounds like, but I think it sounds probably pretty distinguished and amazing. Victor, with momentum and the potential to break, you take the pullback and enter just below resistance inside of triggers. Your stop is 5 ticks above the triggers, where the market should not go, and you say, into the trade, we'll see, I'm feeling relaxed. Your next picture shows that you have already been paid and you have absolutely nothing to lose with momentum and a clear path. And your final one says, I'm out on the other side of the triggers, on the other side of trouble. I accept $210 is a great way to start the day. Does that make sense, everybody? First, it's momentum and the potential to break. Define your entry. Don't be afraid to get paid. It's all right to go break even. You still made money. Great job, Victor. Great job. That is a gentleman that can repeat a pattern over and over because he knows exactly what he's looking for, exactly where he's looking for it, and exactly what it takes to get him into the trade. Pete. Odds favorable, potential to break. You jump in. When your momentum trade fails, you enter the trend trade, and you get paid. Nicely done, Pete. Darn these patterns. Miss Jen. Miss Jen says, with momentum, with the potential to break, I'll get in low, and it got me. Dag nabbit. But with all of those large chart advantages, I will re-enter on the way down, and I'll get paid. Guys, you will have to take trades twice every now and then. You will have to take it more than once every now and then if the rules are still met. And Hunter, I want you to share this lesson with your mom, okay? Guys, I want you to see this. If the recipe for the perfect trade, all right, Hunter, you don't have to share it with your mom. You can anyway. If the recipe for a trade is going to be momentum, clear path, and entry, and Jen does a beautiful job of this. Three triggers through, smalls outside of the large. Momentum on the large chart. Does everybody recognize that it's only the potential to break on the large chart? It is not a clear path yet. And you know that because only 3 of your trigger lines are through. Now I want you to recognize that small triggers are inside of the large triggers. Does anyone recognize this as a loss of momentum? So let me show you how when you begin speaking in terms of advantages, your brain's going to start to click. Your brain is going to say, wait a minute, there's not separation really, but there's a little, so we still have momentum, but my small chart seems to be getting weaker. So if my small chart's getting weaker and the large chart doesn't have a clear path, it may push up a little higher, and that's exactly what it did, Jen. It puts you outside of the triggers where the market shouldn't go. When we talk about the KISS plan, and I want you new users to recognize how hell-bent I am on your success. When you talk about the potential to break, smalls must be outside of the large on the 5-1. And why is that? It's because we're relying on momentum to break that area. And if the momentum isn't perfect, you may not get the perfect entry. Does that make sense? This is where you guys might wait for that confirmation bar. Might wait for a confirmation bar just to say, let me get the foolishness out of the way. Now it's going down. Now I'll get paid. And Jen, that's exactly what you did. Way to keep your head in the game. Because what you did is you said, I know where a potential entry is. I know where my advantage is gone. But my large chart still says everything's going down. Let me wait for a more conservative entry to go down with it. Great job. So RK, on crude oil on the S&P, your initial stop, and this is Rinko, ladies and gentlemen, and I know that you new users are like, why is he talking about two different platforms? Because I've got people on two different platforms. Your initial stop, RK, goes where the market should not. That's the language I want you to embrace. It's going to go about 5 ticks above those triggers. Your initial stop when you're looking at NinjaTrader, man, I got a lot of stuff open, don't I? I crashed again. So when you're looking at NinjaTrader, your ATM strategy, RK, is going to say 12 ticks. So you're going to see 12 ticks. Your job is to take that 12 ticks. It gives you reaction time. And then put it where the market shouldn't go. Sometimes where the market shouldn't go is only 8 ticks. Why give up that extra 4? Sometimes where the market shouldn't go is 15 ticks. Don't short it, putting yourself where the market may end up. Does that make sense? But the initial stop is going to say 12, and that gives you reaction time to put it where the market shouldn't go. Great question. Great question. All right, I'm reloading right now. So where are we? Great job, Jen. Let me scroll up and see who's where, who's next. One of the things, guys, is I've got to go through this chat box, and there's a lot of you guys that are posting, which I love. So thank you for the consideration that it takes me a second to get through everybody's posts. But we will get through everybody's posts. I'm going to click on a few of them. Guys, if I call the wrong name, if I say, hey, Cav, good job, and it was beat, understand that it's not intentional. I know who you guys are, but I'm trying to not miss out, and I'm trying to also expedite the process so we can get back to live chart reads. All right, that was Jen's. Yeah, RK NinjaTrader is resource heavy. It really is. And if you draw on your charts, it's even more resource heavy. There is a way for you NinjaTrader users. There's a way to optimize your computer to help minimize that. And this is one of the reasons that the funding company is focused on focused on TradingView. But here's your NinjaTrader 8 best practices to give you the cleanest run every morning. And RK, I know you don't want to hear this because you're afraid of running resources, but when you post in the room, you're going to get the best feedback if you show me both charts. Tell me what's happening on your large chart. Tell me what you see on your small chart. Because the small chart's only a glimpse of the big picture. All right. Gap theory, waiting on the pullback. What does that mean? That means that if price accelerates and hits a midband, the large triggers are a full bar away, guys, it's very likely to go back and close that gap down to those large triggers, which means no long trades. That's a great read on the gap theory. And then Cav, I believe this is you. Smalls are down, large are down, space between, potential to break, no divergence, strong triggers, pull back just to those large triggers. Pibbies, this is your trade. Termination, back to the small, looks like the large, easy money. The only thing missing is you don't have an area inside of your triggers. But nice job. And then RK, everything says down on this small chart. Everything says down on this small chart. The triggers are strong on the small chart, right? And you just jump in. You say, with that momentum and room to that blue line, I'm going to jump in. And then you hold it. And it looks like you sold even more and you got paid. Nicely done, RK. It's an incomplete picture, but you're trading with advantages, and that's what's important. Smalls above the large, larger wide, space between, pull back to the mid band, right at the triggers, and money is made. That's okay. You know, I'm going to let you in on a secret, RK. The patterns don't know if it's the NASDAQ. The patterns have no idea if it's crude oil. The patterns don't care if it's the S&P, right? The patterns are the patterns. That's what makes it amazing. When there's strong triggers, no matter what the market, when there's at least the potential to break, you can pull back to resistance inside of triggers and make your money. Nicely done, Cav. I recognize Cavs. Trading, this is the NASDAQ, and it's the perfect pattern. So remember, guys, what we're teaching isn't crude oil. We're not talking about the S&P. I mean, we're watching it, but we're talking about a pattern. We're talking about a simple 3 rules on only 2 charts that can give you the advantages you need to pull yours out of the market. All right, Ollie. We got you now, brother. Strong double top, termination, termination, reverses the market. Odds favorable momentum, pull back to the area inside of triggers, and you get paid. And then you hold. Mistakenly used the wrong ATM, should have hit both targets. And then it turned against you. Great trade, Ollie. Momentum, 3 triggers through, strong triggers, pull back to the area inside of triggers. And guys, this is the same trade that we did together as a classroom this morning. Historically, Ollie took the exact same entry with the exact same stop place, with the exact same target, and could have made the 300, but he had his ATM set a little wrong. Still making money. Beautiful trade, Ollie. We actually did that one together as a classroom, bar by bar, to show the entry. Really well done. Let me figure out where we are. A lot of pictures. All right, Paul and George T. All right, Paul. 15-minute price in transition. Clear no. Entry close of long bar with stranded sellers. Okay, so Paul, you were on the weak side with absolutely nowhere to go, and you chose to take a trade that didn't fit the rules, and you lost. What a great lesson. What an outstanding lesson. Take care, Cav. Thanks for being here. I don't have what I need to look for an entry, but I'll take an entry anyway, and I will pay the price. And I'm glad you only lost 2 ticks, Paul. But you didn't have strong triggers. You didn't have a clear path. You were on the weak side. There's just so many problems. Guys, you don't have to give your money away. Keep it simple. Upward trend, smalls above the large. You get above trouble, you jump in with momentum, and you get out before the momentum has a chance to die. Right at a problem area. George T., beautiful use of momentum and room to trouble. And I love that you wrote trouble on there. Great job, George T. Taking advantage of momentum and room to targets. What a great way to trade. Taking advantage of momentum and room to targets. Have you guys heard that yet? Be on the good side of momentum. Don't let there be anything in the way. You will find a way. You will find a way to make money. Momentum, terminations, gap theory. No reason to take a trade, right, Victor? No reason to give money back. Why would you? You don't have what you need. I love it. Same thing, guys. Rinse and repeat, rinse and repeat. Steve Diego. Strong triggers. Nothing in the way. Jump in with momentum on 2 charts and nothing in the way. Get out before you hit trouble. My Nexgen dynamic Rinko bar traders, my ninja traders. When you have momentum and nothing in the way, you will find a way to make money. Steve Diego, beautifully done. Momentum, nothing in the way, you can jump in and make money. Well done. All right, Victor. Not Victor. Everything says up, although it's not the best momentum. You get above the decision-making areas. You wait for it to get above the decision-making areas. You jump in with momentum, and you get out before momentum subsides. Absolutely brilliant, guys. So look at this. Clear path, all triggers up, find a way. Clear path, all triggers down, find a way. Clear path, everything says down with momentum, find a way. I love it. A lot of next-gen dynamic Rinkos going on. I bet we're going to get to some trading views. Guys, we're going to keep doing this. Rinse and repeat, rinse and repeat. How do I do it? Rinse and repeat. Momentum, momentum, momentum. Path, path, path. If I have momentum, if I have room to trouble, I'm going to get in above trouble. I'm going to get out before trouble hits. 8 ticks. Once again, momentum and path. Has everyone recognized by now that 90% of the trades posted in this room are not high probability trend trades? That 90% of the trades in this room have nothing to do with pullbacks to areas inside of triggers, but have everything to do with momentum and path. Once you learn your core, ladies and gentlemen, it opens the doors that you need open. Market reversed out of nowhere. Weak bottom. Strong triggers. Absolutely beautiful. Nothing in the way. Jump the fudge in based on the large chart. Look, get out if anything goes wrong. Guys, momentum and path, once again, another jump the fudge in trade. You guys are getting good at these. George T. Strong triggers, nothing in the way, jump in, get out of trouble. Oh my gosh. George T., are you ready? I'm going to put you on a pedestal real quick. I want you guys to see this. Strong triggers and nothing in the way, get paid at the decision-making point. Do you guys see it? George T. knows that things can go wrong at Fibonacci. He gets paid. And then when he gets back below Fibonacci with strong triggers, he rides it to the next area. And he pauses for 1.5 minutes to make sure the decisions at that fib don't go against his trade. And he just re-enters and goes back down. George T., I hope you're listening. This is brilliant use of the software. You could have entered at the pullback to the area inside of triggers and just taken the trend trade all the way down. Not your trade, right? You're more comfortable with this look. Awesome job, George T. The T stands for terrific. There's no doubt in my mind. Pete. Momentum and path. Jump in, get paid. Is it getting, do I sound like a broken record yet? Momentum and path, get paid. Momentum and path, get paid. Momentum and path, get paid. Momentum, potential to break. Divergence prints, take the loser. Everybody say it with me in the room. What is the biggest killer of the potential to break? Divergence. All right, so I'm going to do this. Victor, you're going to love this, man. You're going to love this. You are going to sing songs about what I'm about to give you here. You ready? I'm going to take a picture of the potential to break rules. And I'm going to put that picture on your chart. Are you ready? So when we're talking about that 50-50 trade, when we're talking about a trade that only has the potential to break, so there's things that we look for. First thing, Victor, is the strong top or bottom. Do you recognize this as a weak bottom? It's not an area that reversed the market. It kind of came from the middle of nowhere. Does everybody see it? It wasn't a termination that stopped and reversed that market. It came from the middle of nowhere, just thin air. So that look right there, Victor, means that this trade is already less likely to work. Odds favorable momentum on the 13-2, 100%. Smalls outside of the large on the 5-1, 100%. No divergence on the 5-1. There it is. Dang it all to heck. So Victor, in a plan designed to optimize your chances of success, you have 50% of the advantages that it takes to give you a more consistent winner. Does that make sense? So guys, this is the plan that I give you as a brand new user to optimize your chances of success. If one of them goes away, maybe you can work your way through it, right, Victor? But when 50% of your advantages are gone, it's all right to not take the trade. The divergence printed after? No. It may have printed after you activated your limit order, but that divergence was true right here. But here's the cool, and the other thing that I want to address. This didn't work, had odds favorable, 3 triggers through. So 3 triggers through is not a clear path. Please don't mistake the two. 3 triggers through is just the potential. A clear path means that there's nothing in the way. So you can't have the same phrase in the same breath. Entry at the area inside of triggers and it just went the other way. That's okay. It's the potential. But what does that do for you? The second you say potential, you know that it's not perfect, which means that you lean on the other advantages, which means that when you see one of them go away, you say, damn it, not my trade. But here's the one thing that I do want to say. Was it a good trade that belongs in the 30%? Guys, the 30% or the 70% potential is high probability, not a medium probability. Once you go medium probability, that 70% is off the table. Does that make sense? So Victor, it's not just a cost of doing business, it's a violation of the rules that ended up with a loser. What a great picture. Some of you are like, man, Mark just whipped his ass, right? Your Spanglish will get better. Primero, es muy importante. Tienes una cosa más fuerte, muy rápido, es muy importante. No tiene, I don't know how to say zones or fibs. Fibonacci aquí. I don't know. My Spanish was developed in a kitchen in Texas. But I can make my way around. But Victor, It's an awesome example, not only for you, but for the people in the room, that we hand you a plan that optimizes your chances of success, that gives you the greatest chance of success. And once you learn it, you'll find other ways. You'll find other ways to make money around it. But until you are consistent, it's okay to keep it real basic, to really learn how to be a little calmer in the moment, just a little bit more patient, because there really is. It's probabilities. All right, RK. So one of the things, and again, RK, I'm going to be a colossal pain in your ass. And I know this, and I don't mind saying ass. It's in the Bible, right? Every time you guys present in my room, especially as you're learning to read the indicators on the Renko charts here, I want you to define the momentum and tell me if you had it. I want you to define the path and tell me if you had it. And I'd like you to define the entry. You did a good job. I can see exactly where you entered here. But the reason we're going to do that is because we're going to let the language dictate whether or not it was time to take a trade. Does that make sense, everybody? So when I talk about momentum, if my large triggers are still up and my small triggers are down, I don't have strong triggers yet. And this just, it's a throwback to the first thing we talk about every day. And I know it's a pain in the butt, but in order to have strong triggers down, it takes both small and large, angled the same direction, and the colors need to match. So you have the smalls down and you have the space between, and this is exactly where you should be as a brand new user, RK. Just learning it a little bit, but the momentum isn't there yet. The path to the downside, I'm going to say, sure, for sure. There's nothing in the way all the way down to Fibonacci, but I don't have the momentum to push it yet. And now the entry rules, guys, this is where language is going to save your bacon. The language says that I'm going to sell a pullback for a short trade, and I'm going to do it at an area, and that area is going to be inside of triggers. And RK, I hope this makes sense. Whoops, that's the wrong indicator. The wrong thing. Here's your trigger lines. Your only area is below, and it's already been run through. So I don't have an area inside of triggers to take that next entry. And I don't have the momentum I need to push it down. So this is a great opportunity where you might go back and say, all right, with a little bit of study, I recognize the momentum isn't there. With a little bit of study, I get that the verbiage for the entry isn't there either. And what you're doing is you're saying, I sure hope the clear path goes down. And man, RK, you are right where you need to be on day 3. Because you're thinking about the direction, and you're looking at the small triggers, and they're down and they're below the large, and you're waiting for the pullback, and you're getting so close, and your study is getting you a step closer every day. So even though it doesn't fit the recipe, I want you to high-five yourself, man. You're putting yourself on the path. You're on your way to getting more proficient. Great job. All right, odds favorable momentum, nothing in the way, pull back to the area on the way to the retracement zone, out where the market shouldn't go. Hunter, I can't fault you on anything. And then the 1-to-1 starts printing, right? I see it. But not where you took your trade. You did have momentum, right? The mid-band wasn't behaving as a termination condition. You did take a pullback right to the area inside of triggers. Victor, this is your 30% of anything that typically wins 70 to 80. That's your 20 to 30 because it fits all rules. Hunter, great entry. They can't all win, guys. All right, trading view. Here we go. Let's get some trading view feedback. Larger above small triggers running into trouble. All right, so K price. And guys, I'm going to go back to the very simple language. Small triggers are down. Let me get the price in there so that I can see where price is trading to. Small triggers are down, and at 64.72, you're in the transition side of the triggers, and you have absolutely nowhere to go. Does that make sense? So small's down. So for my TradingView users, for you new users, this is your chart read every time. Price in transition inside of those smalls need to manage more assertively, and 1 minute trouble more likely to create a bounce. Is everybody with me on this? Smalls are down. I'm looking for shorts. Price is trading inside of the smalls, which means anything over here is more likely to create a bounce. Can you guys give me a why, TradingView users, if you're with me on this one? First, the triggers say down. The transition look says that it's going to be a more difficult look. I might need to manage a little more assertively. Although it was a super risky trade to go short, not typical of my rules, but I have done quick trade like this before, didn't get stopped out and took profit for $3.50. So let's look at your entry. Price breaks the zone, pulls back to the zone with the small still below the large. You sold it. And then I don't know how you're running stops. You make it through the shenanigans and they go back and retest. So outstanding that you made the 350. I've said it before, and I hope it doesn't hurt anybody's feelings. Your money is of no concern to me, guys. What you make on a trade has very little effect on my life. What's important to me is that you can begin to recognize patterns, that you can prove win more than they lose, and that you can be calm and patient when you don't have an edge. So K-Price, bravo on your 350. Is trading directly into zones from the transition side going to be your best chance of long-term success? That's the question that I want you to answer yourself. Todd. And Victor, you said, and this is what Todd is cheersing to, amazing how all the trades from different people all look the same. Amazing how someone in Europe is taking the same trade as someone in India, is taking the same trade as someone in Italy, is taking the same trade as someone in Australia, is using the same advantages as someone in California who doesn't even know the person in Chicago that's taking the same look as the person in Maine. Guys, everything is patterns. Everything is patterns. The market doesn't care who you are or where you are or what market you're trading. It just says, hey, do me a favor, learn me, and embrace the edge. I love it. And all right, so Derek, not a good entry. I didn't take the trade, still waiting for it to go long. I feel like I might have missed one of yours. Did you post one where you said you were frustrated and you feel like you're moving backwards? Did you delete it? Did I miss it or did you delete it? You deleted it? Okay. Show me. Or is this it? Oh, that's it. Okay. I see. I don't always address in the moment. So let's talk about it. And guys, I'm going to tell you, learning the day trade is a cha-cha. It's 2 steps forward, 1 step back. 2 step forwards, 1 step back until you find your groove. So let's go through the very basics. I'm assuming you're thinking long trade here, yes? I will always help, I promise. So you are thinking long. So when we talk about momentum, watch this. I'm going to give you this. I don't know that I've given this in a while, guys. This is your high probability trend trade checklist. Let me drop this in the room for you. So Derek, the first thing is, did you have strong triggers? Well, what does momentum look like? And what does momentum only look like? Small triggers above the large triggers, space between the two. So, guys, this is how recognition starts to pay dividends. Is this look the same as the look that you see? What do you think, guys? Give me a Y or an N in the room. Is it strong triggers, the advantage of momentum? Ooh, let's try it again. So, Derek, are your small triggers above your large triggers? Is there space between the two with the small having broken above? I see small triggers below large triggers. Do you see it now? It has nothing to do with the space. Let's look at the location. They're not above, they're below. So this is where I encourage you guys learn the language. Small triggers up above, large triggers wide. And what happens, Derek, is with a little bit of practice, right? With a little bit of study, looking at all 50 pictures of what it means to have strong triggers, you don't make this mistake. Because right now, we don't have momentum. The odds are not favorable for the market to continue up. Rule number 2 says, do we have a clear path? Well, you haven't quite reached Fibonacci resistance. Do you see it? There it is looming in the distance. Haven't quite reached Fibonacci resistance. You're above anything else that could cause trouble. You very much have a clear path. Whoops, wrong one. You very much have room to targets. Does that make sense? Are you guys with me so far? All I'm doing is breaking this down into 3 individual pieces. So Derek, finally, let's put the language on the chart. Is there a pullback to an area inside of triggers? Okay, let's go back. So what about the red line? Great question. Guys, this is how we're going to get you where you want to be. This is how we're going to get you where you want to be, by you asking these amazing questions. So let's go back to the very basic. Or you know what, even better, let's go to the high probability trend trade checklist when we talk about terminations. Termination condition goes into play, Derek, when price reaches. When the price bar hits, smacks its head on, gets to. Because that's what sets off the decision-making process by these yahoos. They know where those fibs are. They know where they're at. They know that they're there, and that is where they are most likely to enter and exit the market. So in order to define a termination condition, price must first reach that area. If price has not reached the area, that's going to be a target if you find a long trade. Does that make sense, everybody? So the path is clear. Are you with me so far? And Derek, it really is, man. It's a process of breaking it down into the individual parts to see if you have a reason to enter a trade. So the rules say, buy or sell a pullback that begins with a reversal bar, and you're going to do it at an area inside of triggers, and if you take that trade, you know exactly where your advantage is gone. Do you see how you have an entry area clearly defined as well? So far, so good? We're lacking momentum. We do have a clear path. And you can define an entry area on the small chart, right, Derek? So what do we have? I love this. We have one advantage missing. Therefore, it's a medium probability trade, should we choose to take it. That'll be up to you. So if you take a medium probability trade, you know where your stop goes. You know exactly where trouble is, right? Right in that range. And if something changes, you may manage it differently. Let's go see what happened. That was crude oil at 9 a.m. This is the S&P. Let me load up crude oil real quick. So now let's see what happened after the fact. And guys, I think going back and seeing what happens after the fact is important. So at 9 a.m., that was your look, right? And 9 a.m. All right, what time zone are you in, Derek? Because that doesn't look the same. Or was that yesterday? Was that from yesterday, maybe? You're in Mountain? Your computer's set to Mountain? So that would have been 7 a.m. my time? Was that crude oil or S&P? I apologize. That was crude oil. Oh, you know what? You're still in the September contract. So let me turn this into the September contract so I can have the same look. The markets are rolling. It is rollover. So give me 1 second. I'm going to not update. And it should be 9. Are you trading 9 or 10? I want to make sure that I can get the right answer for you here. You are September 25 crude oil. I am September 25 crude oil. Let me reload it real quick so that we can get on the same one, right? So Brian, I check volume. When it's time to roll over, I'll look and see which market has the highest volume. On the first day of rollover, typically it's split. So I'll just let you guys know which direction I've gone for class. But it's all a product of volume. All right, so I believe that was your look. That's still not the right look, though, is it? From 7 a.m.? That was from today? Derek? Was that today or yesterday? Trading at 63.60. 63.60, you had a divergence. So that's going to be higher. 63.60. You had the divergence. The market pushed down. There it is. All right. I got there. So check it out. Let me circle where it was, and this way I can find it on a bigger chart. So this is where we were looking. My triggers look different than yours. Is that right? Or was it this one? No, that doesn't look the same. We have one-to-ones. Hold on. There it is at 63.38, 63.60. Did it just happen? It just happened, didn't it? There we go. Man, I'm a Yahoo. I went the wrong direction, Derek. My bad. So here we go. It did pull back right to the areas inside of triggers, didn't it? But without the momentum to push it up, they tried. And if you use the KISS plan, Derek, and you got in at 45, you lost 5 or 6 ticks trading without the advantage of momentum. Does that make sense? So you had 2 out of 3. I love momentum, man. Well, I mean, just you hypothetically. If anyone in the room chose to take the trade, it did fail. And it failed because the market didn't have the momentum that it needed to keep it continued. Does that make sense, Derek? If you didn't take that trade because of momentum, awesome. You did have a clear path. You had an easy to define entry. The only difference is there was no momentum to push it. And remember that divergence is a loss of momentum, everybody? So Derek, not only did you not have momentum on the large chart, you were also losing it on the small chart. Double whammy to keep you safe. Great job, dude. And I don't think you're going backwards at all. I think that very often we start to recognize and we start to read and things start to make sense and we start to interject opinions. I think you're right where you need to be. So guys, keep it simple, keep it focused. 15-minute at the mid band, 1 minute is at a zone, path is clear to profit target, entry HVA short. All right, Paul. Here we go. I love it. I love it. What great lessons. Sometimes, guys, I'm gonna get comfortable with you, and I'm gonna sound like, come on, you know this. The smalls are up, correct? Does everybody see that the smalls are up? That's the first thing. That's the first thing I want you guys to notice. Okay. We did hit a mid band. Well, hold on. Let's do the whole thing. It is transition, but it's transition up. There's only one trade that's going to have you fighting those triggers, guys, and it's an HVA trade from a termination on the large chart, going through the plan. So, Paul, you hit the mid band, right? 15-minute at the mid band. 1 minute, smalls get below. Sell the HVA, right? Beautiful. Perfect HVA trade, Paul. Mid band, trouble, yuck, ew. And this is still up. Absolutely perfect profit taking. Paul, you took the perfect HVA trade. One of the best targets for an HVA trade is that mid-band. And you'll notice that your mid-band, Paul, lined up perfectly with the VWAP. That volume weighted average. Paul, 100% rock star. You guys are going to go through it. Smalls up. Transition. Is there anything in the way? Wait a minute. Yes. Do I have HVA rules? And guys, that's the only time you're going to find yourself fighting the large chart, small triggers. Is that look right there, if it's right at a termination. And you'll get good at this with a little bit of practice. And Paul, you did it beautifully. So proud of you right now. Okay, Price, you say loss lesson. Let's see what we did. So at the time of the trade, the small triggers crossed above. Crossed above what? Price was between the larger trigger, had potential to go up. So we're going to use language. We're going to use language. And guys, I try to be consistent 100%. So my new users that are on TradingView, everything starts with the small triggers. And the small triggers are, I don't know why I did all caps there. That was an accident. Are down. So for the brand new user, the path of least resistance is to go down with them. All right, but then we're going to ask ourselves, where is price in relationship to the triggers? Is it left of the triggers, which is the strong side, which great things happen? Is it transition, where we start to see the change and shorts become a little more difficult? Or is it the weak side, where if you're going to take a short trade, you want to make sure everything's in favor of it? Does that make sense? And then the final question is there anything in the way? And there is most definitely a zone in the way. Do you guys get it? But when it reaches the zone with the weaker triggers, there's your HVA trade to push up. So thinking you would buy at the midband, however, completely blew through the midband and you got stopped out. So can we talk about the entry at the midband if you're thinking it's going up, K-Price? Are you with me in here? When it pulls back to that midband, and this is what's going to save you. A close on the correct side of the triggers. And this is one of the difference between Renko and TradingView. On a Renko chart, you are going to activate a limit order and you're going to wait for the market right at that midband. You're going to wait for the market right at that Fibonacci area. On a TradingView chart, on a minute chart, these small triggers are the kiss of death, which is why the rules say wait for a close on the correct side of the small triggers. And what you have here, K-Price, is your thinking is good. You're coming from a zone, you're on the weak side, they're trying to roll, the market's already smashed up and it's pulling back to a midband and it never gives you a close on the correct side. This is such a great lesson. Everything still says down on your large chart. Your rules kept you from jumping in at the midband. Your rules kept you from jumping in at the zone. Your rules kept you from jumping in at the HVA. And it looks like your rules are even keeping you from jumping in from down here. Does that all make sense? So remembering that Renko is not TradingView and TradingView is not Renko, and the only time you're going to activate that limit order on your TradingView charts, guys, is if you have strong triggers in the direction you're looking to take that trade. Great picture, K-Price, and I can't tell you guys how much I appreciate when you're willing to post a loser, because what happens is I've taken every loser that you guys will ever take. I've made every mistake that you guys will ever make. I have screwed up every good thing this software provides so that I could teach you how to avoid it. And K-Price, thank you for that. Thank you for having the courage to post a loser and then taking the lesson that goes with it. And I imagine you won't take that loser next time. You'll say, whoa, I can't fight those trigger lines. Because, was that crude oil? What market was that? You were trading, nope, that was the S&P. So let's look at the S&P and let's see what happened. See how the large trigger, or the small triggers, never turned up. And guys, this is a lesson that I want you to get. As a brand new user, do you see how there's nothing here? Everything starts with this read, in the moment. In the read in the moment on the S&P is that the smalls are down, which means that especially as a brand new user, you can just go down with them. Even from the weak side, go down with them. Look for a reason to go down with them. Now they're on the strong side, the left side. And there is nothing in the way between you and trouble. Let's see what the small chart says. The small chart pulled right back to a midband, right back to a zone, and I don't get a close on the correct side of the triggers. Does everybody see it? Until this white bar closes below those triggers, or that red bar closes below the triggers at the area, and from that close below, ladies and gentlemen, it is Downsville, population U. So if you're brand new with me, small triggers are down, Strong side of the small triggers, these trigger lines that turned against you said be patient, be patient, be patient, be patient, be patient. Get in the trade. Let's make some money. Can you guys give me a why if that makes sense? First, the large chart says that we're looking for down. Then the large chart says that price is left of the small triggers. This is the greatest look I could ever hope for. There is absolutely nothing between that price and that trouble, because the small triggers turn against me. My job is to wait for the trend trade style entry from the close on the correct side of the small triggers, at a zone, at a mid band, at a 1-to-1. And when it happened, when I finally got a close below, it was, even if you took this close at 73 and change, it was 68 and change down here. And that's 5 points. And that's $250 per contract. So if you're brand new with me, so Mr. Paul and Carlos and who else is new in here on TradingView? This is what we talk about every day, the same way we do it on Nexgen Rinko. We talk about having an advantage with the trigger lines. We talk about recognizing trouble, and it is still going down. We'll see where it ends up. So every day, we talk about the same thing, ladies and gentlemen. Every day, I give you a plan. For NinjaTrader, it's momentum, path, and entry. For TradingView, it's momentum, path, and entry. You get clearly defined entries, no matter what you're on. You get study tools, no matter what you're on. And most importantly, if you just take the time to post in my room, you will get feedback on every chart you present. You will get every question answered. You will get every tip and trick that I have in my arsenal to help you. And if you're here on TradingView and you've got that free $50,000 evaluation account, guys, I want to help you pass it. I want to help you beat the hell out of that evaluation. I want to help you with a couple simple rules and a lot of feedback. Get to the good side. Get to the semi-live account. Get to the point to where you can make money with it by following a very simple path, guys. And this will be the same thing that we do every day. The same thing that we do day in and day out. First, it's momentum. I have none. I could stop right there. Who cares what the path is? I don't have the momentum to push it. I don't have a clear path down. I don't have momentum to push up. This is not my market. I don't have momentum down. And when I had it up, I didn't even have the potential to break, and sure enough, it went down. And even with momentum down, I knew exactly where the market may stop, and sure enough, it bounced up. And even with a retracement to resistance, with all the triggers below, I knew that it was more likely to go down. But with all the momentum, with the potential to break, the market pulled right back to a mid-band, right inside of triggers, and if I'm not mistaken, ladies and gentlemen, we took this one live in the room, and it went right to trouble where we made $250, and we got the hell out of the market because trouble could have stopped it. Every day. So welcome to Nexgen, ladies and gentlemen. I am excited to have you here. Welcome to Nexgen. Let's go through it. Are you ready? Let's go through the simple 3 things. Derek, are you still in here? RK, are you still in here? New users, let's rock this one. You ready? How do we feel about momentum? What's my momentum look, guys? Smalls, below the large, space between the two. What do you guys think? Do I have the advantage of rule number one, a market that's likely to continue in the direction of the trend? 100%. Don't overthink it. Beautiful. Do I have a clear path? Has price reached a Fibonacci support? Has price reached? No, it did not do a reversal. Has price reached an area? Has price reached something? No, exactly, Mr. Paul. The path is clear. There's our large chart advantages. Guess what? I'm done with my large chart. So your entry rules, in order for it to be an entry, and I want you guys to write this phrase down. I will sell a pullback. Mark, what's a pullback? A pullback is a small move counter to the underlying trend, right? That's a pullback. That's a pullback. I will sell a pullback at an area inside of triggers, because triggers define the retracement. So check it out. The reversal bar begins the pullback. Lets me know it's going up, counter to everything over here. The trigger lines define where the pullback is most likely to go. Now, give me a number in the room, everybody. How many areas are inside of my retracement zone? How many areas are inside of my retracement zone? Does anybody see Fibonacci? Does anybody see a mid-band? Does anybody see a one-to-one? Derek, you see 3? All right, so now this is why I asked the questions, guys. This is Fibonacci. Fibonacci resistance. This is a mid-band. These are yellow one-to-ones. These are where trend trades originate, ladies and gentlemen. Areas inside of triggers. Here is the bottom line of my triggers, and here is the top line of my triggers. Guys, the shaded area represents the point where if my advantage is going to stay in play, this is where the market is most likely to retrace. So I'm going to ask again, inside the highest line of the triggers to the lowest line of the triggers, how many areas do you guys see in there? Do you see Fibonacci? No. Do you see a mid-band? Absolutely not. Do you see yellow one-to-ones? The answer is no. I don't have any areas inside of triggers. And guys, the thing about areas inside of triggers, we're not looking at your chart though, David. We're looking at my chart. Is once you get beyond the retracement zone, and this is where management comes in, once you get past the retracement zone, and we can say that as above the large triggers, you will not know if, when, or where the market may continue down. Rule 3 advantage is no longer in play. In fact, it is such a hard and fast rule, ladies and gentlemen, that your initial stops are typically placed 5 ticks beyond those triggers, which means your market is already where your stop belongs. Does that make sense? And if your market is already where your stop belongs, you don't have an edge. You don't have an advantage. Ladies and gentlemen, look what happened with only 2 out of 3. Your entry rules are going to save your butt more often than not. Pretty cool, right? Mark, how did you know not to take that trade? How did you know not to jump into the mid-band? Because our rules are a pattern. If your rules are met, RK, if your rules are met, and watch this, if your rules were met, if you had an area, check it out. Watch this. This is your large chart read, ladies and gentlemen. Do I have momentum? What do you think, RK? Smalls, below the large, space between? Yes. Resounding yes. Do I have a clear path? Are 4 trigger lines? Because there were no areas, Brian, because the language is unbelievably specific. Areas inside of triggers. Areas inside of triggers. So we're going to go through it bar by bar right now. I love these questions, guys. I love you guys. Not a clear path, RK. How come? Because only 1 trigger line, 2 trigger lines, 3 trigger lines are below the zone, which means it has the potential, and it's a good look for potential. Does that make sense? It's not a clear path until all 4 trigger lines get below trouble. So we're working with the potential. We got all the momentum. Let's go see if we can define an entry. My rules say, and guys, I want you to learn the language specifically. To define an entry, my rules say that I'm going to sell a pullback at an area inside of triggers. So even before the reversal bar, look at the triggers. Look at what areas fall within. You guys see it? There's a fib, there's a fib, there's a mid band, but I need a reversal bar on my smaller, faster chart. So it goes down, and it goes down, and it goes down, and it continues down, and it won't stop going down. And look at this. My triggers got lower, didn't they? And it goes lower, ladies and gentlemen, until finally, there's your reversal bar. So let's go through the language of entry. I hope this is helpful, guys. I love doing this. With momentum, with the potential to break, it's not a clear path. If I'm going to take this trade, the rules say, check it out. And Brian, this is for you. This is why I think learning this language is so important. I'm going to sell a pullback. So guys, the pullback begins with the reversal bar. The reversal bar is not your entry. And I'm going to sell a pullback at an area. And when I say an area, I need a fib, I need a bid band, or I need a yellow 1-1. So the key to the recipe, Brian and everybody else in the room, that area needs to be inside of those triggers. Higher than the low part, the lowest line, and lower than the highest line. And that's my entry for rules. I'm going to sell a pullback at an area inside of this retracement zone. So what are our options? I have yellow 1-1s inside of triggers. Does everybody see it? Let's put this up here. I have Fibonacci resistance inside of triggers. I have Fibonacci resistance inside of triggers. I have a mid band inside of triggers. So I have 4 areas inside of triggers. When you see this look on your large chart, you have to believe that it's going to be difficult to stop. It is a freight train to the downside. The rules tell us that if we sell a pullback at an area inside of triggers, we're going to sell the lowest area, closest to the reversal bar, which means that you guys are going to right-click on your chart, and I'm going to make it look like a sell stop. And you're going to put in a limit order just below the lowest area inside of triggers. Is everybody with me? Large chart tells me to look for the entry. Small chart refines the process. The market comes up. Congratulations, you're in a short position just below the lowest point inside of triggers because of momentum and the potential to break. Now your stop, your stop is going to go 4 to 5 ticks above the triggers because that's where the advantage of entry is no longer in play. Does that make sense, everybody? So not only do you know where the market is most likely to continue, but you also know where the market should not go if this is going to be one of those winners. Let's see what happens. They turn against you. Sons of guns, right? And they go up, and then they bounce. And guys, you are a freaking sniper. And the KISS plan says if you get a reversal bar in the direction of your trade, well then your new stop is 2 ticks above that reversal bar. And all of a sudden, you've got $50 of risk per contract with all the momentum and the potential to break. And let's see what the market does with all that momentum and the potential to break. That's not a bad way to make a living, ladies and gentlemen. 3 minutes, at least $300. And it was that tiny little tail on the large chart that was your pullback to the area inside of triggers. So as the market continues down, watch how this happens, guys. We still had momentum and path, right? Still had momentum and path. So we're going to wait for the reversal bar. Oh, love you back, Miss Anna. Have an amazing weekend. Let me know if I can be helpful. So here comes your reversal bar, ladies and gentlemen. Where is it? Where is it? There it is. So once I get the reversal bar, do you guys want to go through the exact same process? Let's define the retracement zone. Somewhere from the highest point of the triggers to the lowest point of the triggers is where the retracement's most likely to occur. But the rules say find an area, a fib, a midband, a yellow 1-to-1, something in that retracement zone. Can you give me a Y in the room if you recognize that there is no area inside of those triggers? That we rely on those areas to give us a bounce? A lot of you are going to say, you know what, Mark? I don't care about your rules. I'm going to sell the midband. I'm going to sell the midband. It's magenta. I've got momentum. I've got path. You're not the boss of me. And you're going to say, I can't wait to take this trade because this trade is at a midband and midbands are amazing and whoa, what's going on? Wait a minute. Why isn't the market stopping? Why isn't the market bouncing? Because you, my friend, broke your entry rules and got in on the wrong side of the triggers. And everything that I do in this room is like your grandmother pulling you close to her apron, trying to keep you safe. So if you do me the honor of learning how to identify momentum through strong triggers, how to recognize termination conditions by counting the triggers when the market gets there, and how to define your entry with very specific language, you don't have to give away $300 or $400 every time your rules are broken. You can simply wait for the next good trade. 2 triggers through the area is only the potential to break. You did have an area inside of the triggers, but check it out. Does anybody remember that the first rule for the potential to break is to come from a termination condition that reversed the market? Not candles, has nothing to do with candles, RK. Has everything to do with triggers. Fibonacci support. Do you see how price reached it? I love that question. That's okay. Has nothing to do with Renko bars or candles. Everything is triggers. The only thing that these Renko bars tell us, RK, is that price reached Fibonacci support. 4 trigger lines are above. The same way it happened right here. That's a termination condition. But watch how it grows. As the market goes down, now 2 trigger lines are below Fibonacci support. It has the potential to break. 3 trigger lines are below Fibonacci support. It still only has the potential to break. The path is not clear. The path is not free sailing until 4 trigger lines get below Fibonacci support, and now Fibonacci support is behaving as resistance. This is the most basic way to not get caught. Well, price reaches the area. It's the Fibonacci areas, RK, where the large crowd is making decisions. And I want you to see it. Price reaches it. None of the triggers break, and it rattles on down. Price reaches support. The triggers don't break, and it bounces back up. It comes back to resistance. None of the triggers get above it, and it shoots down. It hits Fibonacci support, 4 trigger lines above, and it goes right back up. Fibonacci, well, this was resistance in the moment. The triggers don't break it, and the market continues down. You know exactly where those decisions are most likely to be made. You can let 4 trigger lines get below it, so you have a clear path. You can let 4 trigger lines get below it, so you have a clear path. And check this out. Do you see how 4 trigger lines are below? There's space, not a lot, but there's space between the small and large. What does that look like on your smaller, faster chart? Let me find my circle. That wasn't the one. It looks exactly like a pullback to resistance inside of triggers. So the trigger lines tell the story, guys. The trigger lines will let you know whether or not you have momentum. The trigger lines will let you know whether or not you've broken the area. The trigger lines will even define your spot for entry. Everything leans on those trigger lines. So it's important that you learn the very basic language. Morgan, the only thing you didn't have, brother, was a strong bottom. The only thing you didn't have was a strong bottom. And in the KISS plan, there's a reason that's the first thing that we talk about, guys. Let it be a termination that reverses the market, that sets you off in the other direction. That's what creates the advantage when it's only the potential to break. Stomped on. The price of doing business, or Morgan, the price of going outside of the plan that's been proven to win more than it loses. Potato, potato, my friend. Potato, potato. I promise you guys, I talk about the same thing every day. So as we end the day here, welcome to Nexgen. If you're brand new, if you are getting on TradingView and you're going to be a part of that funding company, guys, welcome to the funding company. I want you to pass. I'll teach you how to pass. All I need you to do is keep coming back and keep asking questions. RK, Derek, remember that you're new. Give yourself a little bit of grace, okay? It's okay to be new, and it takes a little time, and that's okay. But it's getting a little better every day, isn't it? It's starting to make a little more sense. The language is starting to make sense, guys. I ask everybody, give me 3 or 4 days so that we can get on the same page with language, and you'll get to where you want to be. There's no doubt. And let me grab these last ones, guys. These are the last charts. Andy, liar, no rules here. Took profit. I don't know what you're doing, Andy. I see shorts. I can't see where it went. I'm assuming you went long against everything. Can I use the mid-band as a bounce? Yeah. Andy, I got no idea what you're doing, brother. I don't know what your large chart says when you're coming in here. It sure looks like everything is going down. and you went long, and I'm so glad you made money, Andy. Is that how you're going to make money every day? Mr. Paul, it's great to meet you. And I promise you, we are going to get you where you want to be. Just keep talking, keep asking, keep being a part of my room, and you'll be amazing. You'll be amazing. Not 3 bars, RK, 3 triggers. 3 triggers, not bars. You'll get there. The language will start to fall into place. It really will. Andy, I love you to pieces, but I have no idea what you're doing on your charts. You're fighting everything. How does it work for you? Like in the room, you're like, look at me win, look at me win. Andy, you didn't discuss any of these longs. You didn't discuss any trades. Are you just showing me the winners? Right? Everything says down, and you've done a lot, but you're only showing and talking about where you made money. Guys, that's cool. That's your right. If you really want to get to where you want to be, show me where you lost money. Show me where you didn't make money, and I'll teach you how to fix it. Ollie, weak bottom. Did you hear the lesson for Morgan? Potential to break. When it comes from a weak bottom, guys, this is less likely to break. Smalls are returning to the large. There's no separation. You're seeing momentum start to die. Entry makes perfect sense if the rules are met. Stops a little excessive. Stops a little excessive. Does that make sense, Ollie? Be good. Guys, I'll hang out. David, thank you for showing me 32 acres of chart. I like it. Strong triggers. David, were you in here for the lesson? Oh, you had a fib, huh? You had a fib. So, David, guess what? Perfect. 100% perfect. Odds favorable, clear path, pull back to the area inside of triggers. There you go. David, this is a 5-1. It's a 5-1 fib that's showing up, but it's not showing up over here. Are you with me, David? I want to talk about this real quick. For whatever reason, your fib's not showing up over here. But watch how this changes. If your 5-1 fib is over here, your synthetic should be there. I see it there. I don't see it here. If you see a fib here, believe that it belongs here. That was one of those potential to break trades. Do you see it? And divergence printed on a potential to break trade. So guys, if you're missing a fib on your large chart, and it's weird, I would probably reset data, David, because that 64, 65 fib should have been right there, letting you know that this was only potential, and divergence is the biggest killer. I would reset data, I would repair data, but it makes total sense based on your charts, 100% good trade. Price returns to the large triggers, ladies and gentlemen. All right, let me get you today's video.